the pace of economic growth down closer to potential with the hope of bringing inflation down, or is there more to do? And that's a decision that the Fed is going to have to make over the course of the year. If inflation doesn't come down and the Fed does determine that it needs to do even more policy tightening than what it's telegraphing or what the market is expecting now, then that does imply a significantly tighter backdrop of financial conditions, and we should think that recession risks naturally rise alongside that.
Hey, Rob, you are one of the very best, and it's awesome to catch up with you this morning, buddy. Thank you. Robert Rosner there of Morgan Stanley. It is not an either-or. I thought it was a really interesting use of a Volcker quote in Governor Brainer's speech just yesterday. Here's the quote of the quote. 40 years ago, Paul Volcker noted that the dual mandate is not an either-or proposition, and that runaway inflation would be the greatest threat to the continuing growth of the economy and ultimately to employment. There is a belief here, Lisa, that ultimately this recovery is unsustainable, and it's not a choice between one side of the mandate over the other. They've got to do something about inflation to protect the other side of it.
You're seeing a similar kind of sentiment echoed by a lot of retail analysts, in particular on Wall Street, saying right now the estimates are too high and consumers are going to stop spending as much. And on the margins, you're starting to see that sentiment bleeding out. How much does that really edify this either-or proposition that really underscores the importance of bringing down inflation? Bit
of breaking news, TK, in the last hour. Let's recap that on Russia. Russia's finance ministry saying that foreign banks declined to process coupon payments of $649.2 million on its euro bonds. The payments have been sent, TK, in rubles.
This is John, and I've got the prospectus up in front of me. You can do that on the Bloomberg. It's amazing the data that you've got available. And this goes back to 2012, 2013. And this has been a very successful offshore issuance for Russia. And I can't find the exact language, but I presume in this long prospectus, it says it's got to be paid in dollars, and that's the debate.
Damien Sassa, wanted to get him on the phone just quickly to run us through all of this. Joined us from Bloomberg Intelligence. Damien, walk me through your interpretation of what we've learned in the last hour.
Before going there, Jonathan, I'm wondering if Tom could share those bond docs with me, because they're very, very difficult to get a hold of. Certainly Fitch and some of the rating agencies have ratings on some of the local bonds for Russia, and they don't actually have the bond docs. So I'm just saying, if Tom has access to that, that's a pretty big deal. Anyway, so going into this, I mean, $500 million of the $2 billion principal, which was due on the 4th by Russia, was supposed to be paid in dollars. Clearly, the new sanctions are preventing Russia from doing that. $650 million thereabouts was supposed to be paid in dollars to foreign creditors, but this new rule is preventing them from doing so. And so, if rubber meets the road, this looks like the U.S. government is absolutely going to force Russia into a default unless they can find the funds from elsewhere.
I look, Damien, at where we are, and there has to be a next. What is the next step in this dance?
So for me, the next step for me is looking at the Credit Derivatives Determination Committee and their ruling on Russian railways. You know, they were asked to rule if the credit default swaps, which banks have underwritten on the back of the bonds, are indeed triggered into a failure to pay credit events. And so we should hear about that in the not too distant future. For frame of reference, Russian Railways owes $31 billion in sterling coupons that were due on the 25th. They missed the grace period. If the CDS Determination Committee, basically considers this an event of default, a lot of money is going to start to change hands, and that's going to trigger an awful lot of money movement that you can't come back from.
Lisa, here's the two sentences that matter. Interest, B item. Payments of interest other than interest due on redemption in respect to each bond will be by U.S. dollar check, CHEQUE. That's what you spell it, folks, when you're fancy like Damien. Drawn on a bank in New York City and mailed to the holder or joint holders of such said bond.
I gotta say, John, one of my questions when I read the story, did Russia actually try to pay in dollars? How could they verify that? In other words, how much is this a story to tell to try to appeal to creditors down the road after that inevitable default?
This is becoming quite a drama, isn't it? Hey, Damien, great to catch up, buddy. As always, Damien Sassa there from Bloomberg Intelligence. We'll keep you on top of that story through the morning. Here's another one for you. Bulgaria and their view on things. Lisa, they say it is prepared for an EU embargo on Russian crude and on Russian gas. The conversation's changed in the last 24 hours. I don't think in a massive way, but it's starting to go in that direction. Whether we get there or not, I think a lot of people are still very skeptical about that.
You know how yesterday I was thinking, why aren't oil prices responding more to this move into energy? Some people saying, actually, it's a relief that they're not going more hard on oil and gas at this point.
Brent crude, 108, very close to that level, up by more than 1%. On WTI, 103.40, up by 1.4%. Coming up on foreign exchange with DXY very close to 100. Win thin of Brown Brothers Harriman.
What's happening on Wall Street?
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
The Indian city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
It's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Given that the recovery has been considerably stronger and faster than in the previous cycle, I expect the balance sheet to shrink considerably more rapidly than in the previous recovery, with significantly larger caps and a much shorter period to phase in the maximum caps compared with 2017 to 19.
Governor Brainerd just yesterday shaking things up in this bond market. Good morning to you. Futures are negative 0.7% on the S&P. On the Nasdaq 100, down by more than 1 full percentage point. Yields higher yesterday by 15 basis points. You can add another 10, up 10 basis points. Tom, your yield on a 10-year, 265 on a 10-year yield this morning.
Getting the 4-day chart out on the real yield, John. We've just vaulted out to a new, lesser negative statistic on the 10-year real yield. I'm not on the zero watch yet, John, but at a negative 0.22, that's a wow Brainerd statistic.
22 basis points away, Tom. We've turned around quickly, haven't we?
We have, and the yield's there, and we'll watch it through the morning. Lots else going on, and part of that is stronger dollars. John mentioned that blended big trade index, DXY, out near 100. This is a joy. WinThin is at Brown Brothers Harriman out of Colombia and with all sorts of international duties, truly expert on his Southeast Asia and Burma. Dr. Thin joins us again from Brown Brothers Harriman. Buried in your note is something short-term that we haven't mentioned, and that is a small matter of Macron and Le Pen and the French election uncertainty. Are you suggesting that's driving weak euro?
I think that's one of the factors. Obviously, the fact that the euro, and first of all, thanks for having me. It's always a pleasure. Obviously, the major factor is that Europe is so exposed to the Russian crisis, energy, et cetera, et cetera. But yes, I think that's kind of creeping under the radar. We've got the first round election this Sunday. Macron has been so focused on Ukraine and Russia that, in a sense, he's neglected sort of his domestic political duties, and Le Pen has been roaring back. A Le Pen victory would be very, very negative, euro negative. And it's a close call. As you know, with the Bradley effect, the polls, tend to underrepresent, the candidates are, what we call, sort of controversial. So it's going to go right down to the wire. And yet it's another, sort of weight on the euro besides the Ukraine crisis. Plus the weaker, data. It's a mess over there.
Win, what is the level of euro, not so much where things fall apart, where we really tip into the perspective of weak euro or euro unraveling?
Well, the thing that's been recently is that this dollar rally has come in sort of these fits and starts, right? We have a strong data or a hawkish Fed, we got a big jump, and then the sort of dollar sort of settles in and kind of goes sideways. So the pace of euro weakness has not been huge. It used to be, you'd think that the Europeans would welcome a sort of weaker euro, but I think with inflation, such an issue, it's become more of a problem for them. Weak euro feeds into the imported price pressures. I haven't heard any official sort of complaints yet, as opposed to Japan, where we're starting to hear more and more. But I have a target of 106 and change for the euro. That was the March 2020 high. It's not that far off. We're talking a couple of percentage points, 3 or 4 percentage points. It's all about the pace, as you know, in the foreign exchange markets. And for now, I like the dollar higher, but the pace has been pretty controlled. We've sort of been moving up in these little ranges from time to time. So anyway, it's worth keeping an eye on. I think any euro bull has got to be disappointed. We have 125 basis points of ECB tightening priced in over the next 12 months, which I think is way, way aggressive, but much more than it was basically zero expected at the beginning of the year. So despite heightened Fed, ECB tightening expectations, the Fed is really just swamping everything.
So just to sort of emphasize this, do you see if the ECB moves that many times, if they raise rates repeatedly over 4 sessions, you think that that's not enough, that that's already been priced into where the euro is versus the Fed expectations?
That's right. I think the Fed expectations seem to be moving much faster. Right now, if you look at the Fed funds and the swaps market, there's a terminal rate of about 325 now is being priced in. Very, very, much, much higher than it was even a month ago. Again, it's all fast moving. These moves in the rates markets, I think we've all been sort of lulled into a complacency. These are moves that we used to see back in the 90s, the 80s. I think a lot of the traders that have been here maybe for 5-10 years, we haven't seen these kind of moves. The rates markets have been artificially depressed by central bank intervention, QE, et cetera. And as these central banks remove the QE, the sort of asset purchases, I think we're going to see much, much greater moves, especially with liquidity drying up.
So given the fact that you are expecting to see bigger moves and perhaps greater dollar strengthening, what does that do to the emerging markets complex, especially given some of the pressures that are coming from food inflation and oil and gas?
Yeah, I mean, Lisa, that's really a great question. I started this year off very, very negative on EM just because of the whole global liquidity story. It's not just the Fed. If the ECB is tightening, that they join the Bank of Canada, the RBNZ, Norges Bank, go down the list. There's an unprecedented removal of global liquidity. We've never seen a pace like this in the past. We obviously after the great financial crisis, we've seen this sort of removal, but nothing on this grand scale and nothing of this pace. The Fed itself has said this is, we're moving much faster than we had in the past. We need to. So that's in general very negative for EM. Global liquidity, abundant global liquidity is really positive for sort of risk assets, spread product. And so I think EM will suffer. Now, the good news is that if you look at the best performers year to date in currencies in emerging markets, it's Brazilian real, Mexican peso, Chile, Colombia, Peru. These are the countries that have actually tightened aggressively. So there is hope in a sense that rate hikes can help the currencies sort of outperform, but the real economies are going to suffer. The rate hikes that, I think Brazil is up around 12%, 11.75%. That's going to slow the economy. So there's a good news, bad news kind of thing in that, I think you touched on the Russian default earlier. I think the frontier markets particularly are vulnerable. You obviously know Pakistan, Sri Lanka are under severe pressure right now, not just economic, political. So the weaker links in EM are really going to suffer. And that's unfortunate. That's the way it always works in sort of this turn in the global tightening cycle.
Hey, Win, thoughtful stuff. Thanks for being with us. Win Thin there of Brown Brothers Harriman on the FX market, and not just in Europe and the United States, but beyond too. Here's the lead paragraph from Bill Dudley's piece this morning. Lisa mentioned it a little bit earlier on Bloomberg Opinion. If you missed it, here it is. It's hard to know how much the US Federal Reserve will need to do to get inflation under control, but one thing is certain. He goes on to say, to be effective, it'll have to inflict more losses on stock and bond investors than it has so far. That published, Tom, this morning, the former New York Fed president joining us at 7:30 Eastern time, so about 35 minutes from now.
Well, the linkage in the stock market's really, really important. This was Greenspan 101. Alan Greenspan, John, would lecture on the importance of the stock market as an indicator of confidence and also folding right into the business part of GDP. I think that's what Dudley's alluding to, and they're very much linked. And in an economics textbook, John, the stock market is like chapter 22, and to be honest, John, nobody gets to it.
Lisa, this is a point you've made repeatedly over the last couple of months.
Yeah, as he says, Bill Dudley says, so far the Fed's removal of stimulus hasn't had much effect on financial conditions. What will it take for that effect to be felt more seriously?
Futures this morning, and good morning. We're down by 1.13% on the NASDAQ 100, down 0.75% on the S&P 500, and yields are higher by another 10 basis points on a 10-year yield, 265. On TV and radio, this is Bloomberg.
Traders, how are you today? I'm going to place an order to buy euro. The price I'm looking to buy 109.07. This is quite close. Okay, 109.07. Order placed. So stay with me. If you want to trade, place your order to buy euro against United States dollar. Sorry, 07. Okay, stay safe and I'll speak to you later.
It's almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping. But many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada. Tapi nggak kayak dulu. Kalau dulu ramai sekali. Sekarang paling dapat jualan ya 100, 120 gitu. 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 tuh nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
COVID inflation to conflict inflation. I don't see energy prices coming down that quickly. I don't see food prices coming down that quickly. And I think that's going to be a real problem globally.
Higher inflation is eroding confidence, and that's been true now for many months.
The Fed now has to come out guns blazing, declaring that they're going to counter inflation because that's their job.
The Fed will ultimately be successful in knocking the inflation rate down.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Equities continue to struggle from New York City for our audience worldwide. Good morning, good morning.
Okay, guys, as you can see, we need to cancel order to buy because it's moved far away from our order, okay? Order cancel for time being, please cancel as well, and let's wait. We'll wait what other pairs will give us, or maybe it will move to another good price that will allow us to place an order to buy or sell short euro. Okay, stay safe.
U.S. yields move, particularly the real yield moves with a vengeance, and the others in Russia, where the D word is being discussed, default.
CPI next week before we get those earnings, Tom, from JP Morgan. It could have an 8-handle,
Yeah.
And the response from the Fed is let's go. Most people conclude they're late. They're pushing for a 50 basis point hike in early May, and now it's on to balance sheet reduction. And that word, Tom, rapid, that Governor Brainerd used yesterday.
It's Rapid Pace Wednesday. That's what we're calling it. And the rapid pace is, I don't know which number of inflation causes angst with that testimony that we're going to see today. Clearly, that's going to be part of it. But, John, to me, it's not the level of inflation. It's the duration of high inflation. That's a mystery. But what if it's months? What if it's quarters?
Would you like the early survey from Bloomberg for CPI next week?
Please.
Just got 3 estimates in so far in our survey. The median estimate so far, Lisa, 8.3% for the March CPI report in the United States of America. 8.3%.
So this is my question. Do you think that this will matter, or do you think that this is baked in, given the fact that even the Fed says that haven't seen the peak yet of consumer price inflation? Is this going to be more important than the earnings to see how much it's actually crimping consumer appetite? Or are we really going to see the focus on how much we're seeing the bottom line and, frankly, profit margins impeded by exactly this inflationary pressure?
This won't change May. If we see deceleration through the summer, it might change the path. But for May, I think we're on course, aren't we, Lisa? We were set up by Chairman Powell at the last meeting on March 16th. Look to the minutes are later. Look to the minutes for the balance sheet plan.
And that really is the key deciding factor. 50 basis points seems to be the given at this point in terms of what's next for the May meeting. Balance sheet reduction, do we understand the implications for markets? Do yields go higher or do they go lower?
Well, exactly.
Because frankly, it disrupts some of the economic trajectory.
We can have this debate on what QT means. Does it matter? And then ask someone, well, what does it do? Yeah. What actually happens and what happens to a 10-year yield? And Bramo, the fixed income universe is very divided on that still.
Completely. You have a lot of people, including Steve Major over HSBC, saying this is restrictive, and that leads people to go into the longer end, and you have that really repeated by strategists across the street, and then you have others saying it's a supply and demand story. How can you really argue with that?
Let's whip through this price action. The Nasdaq 100 is lower again by more than 1%, down by 1.1% on the Nasdaq 100. On the S&P, we're negative 0.7%. Talked about that move yesterday on a 10-year yield up 15 basis points. Here we go again, up 8 or 9 to 263.32. Lisa, after breaching 265 in the last hour.
Remember when we were talking about how amazing it would be if we saw 2.5% 10-year Treasury yields? Here we are and then some. Where are we headed in terms of that end rate? Continues to be a debate. What I'm looking at today at 10 a.m., Treasury Secretary Janet Yellen will be speaking to a House subcommittee on her outlook for the economic trajectory, in part because of the war, in part because of some of the aid that U.S. and other nations would like to give to areas that are getting hit by some of the food shortages. She talked about how this will have enormous ramifications for the world, for the economy at large. What are those economic ramifications? Will she specify that at a time when a lot of people are starting to use the R word more and more? At 10:30 a.m., John, I know you're watching us very closely. Oil executives come to the House subcommittee that is titled Gouged at the Gas Station. Big oil in America's pain at the pump. Draw your own conclusions about the tenor of that. ExxonMobil, BP, Chevron, Shell, and Devon Energy all coming with their executives. How will they be coming? Will they be coming by private jets? And will that be the focus of the discussion? And at 2 p.m., we do get those FOMC meeting minutes. We are expecting to hear some details on how they plan to wind down the balance sheet. Lael Brainerd talking about, to your point, Tom, the rapid tightening, the rapid reduction in the balance sheet, and that could be as soon as the May meeting. What does rapid mean? Do they give us a sense of this? And then, John, do we start to get people gaming out what that means in terms of equivalent rate hikes, given the fact that they're already pricing in quite a substantial move, the fastest, in fact, going back to 1994 for this year?
Lisa, looking forward to that hearing that you mentioned as well. Those words from Senator Manchin, better to walk or hitchhike than take a private jet. We'll find out if they did take a private jet a little bit later this morning, I guess, when that hearing kicks off. I want to kick things off with Citi and this line from them. The headwinds from geopolitics, slowing growth, rising inflation, and a hawkish Fed are considerable. However, negative real rates remain an important support. We can have that conversation now with Scott Cronert, the Managing Director of U.S. Equity Strategy at Citi. And Scott, let's start with that line. Negative real rates remain an important support. That support's quickly evaporating, isn't it?
We're keeping a close eye on it, yes, but it looks a little bit different than it did even a couple of weeks ago. There's no question, our view has been that, a focus on real rates helps to provide some context around the price action in the underlying markets. And heretofore, what we think we saw was a very clear real rate correction in January that we're now on the other side of. And our view very quickly is that this is supportive of equities from an asset class allocation perspective.
I look, Scott, at the formation here, and to me, so much it comes from the sell side securities research, the company by company analysis of revenue down the income statement to some form of EBITDA or operating income and all the margin dynamics. What's the nuance you take from securities research at Citigroup?
So, Tom, this is a focus that we've had for some time now. If you look at the first year that we've dealt with this rising inflation circumstance, which literally kicked in a year or so ago at this time, well, we exited Q4 with record EBIT margins for the S&P 500. And this was true across most sectors. And in fact, profitability remained very robust, as you saw via S&P 500 earnings results throughout the year, again, culminating with Q4. So the way we're thinking about it is that heretofore, right, and this is prior to the current Middle Eastern European circumstance, the earnings response to inflation increasing has been a net positive from our view. And this has actually been aided and abetted by the energy complex, if you will, where it's been accretive to S&P 500 earnings. My point here being that we exit Q4 and go into Q1 earnings results with a lot of earnings inertia behind us that we think will be, it'll take some time for that to respond to a lot of the Fed policy initiatives that are now being discussed.
Scott, what's the downside risk to stocks if those earnings reports that kick off next week are incredibly disappointing?
Our view on this has been fairly consistent. I think the downside risk to stocks is what we consider to be a growth scare. Growth scares that usually align with something, along recessionary conditions. Heretofore, we haven't seen that in any of the numbers. In fact, bottom-up earnings growth expectations have been rising for the S&P even through this past week. So essentially what has to unfold in our view to turn more materially cautious would be just that. We proceed through the Q1 earnings reporting period. We begin to get some caution regarding the second half, but probably more importantly, the 23 outlook. And that's where you begin to draw, a line in the sand, if you will. Right now, bottom-up expectations for 2023 for the S&P 500 are still high single digits, if not 10% earnings growth expectation. That appears, aggressive with the trajectory that's now being discussed, but we don't have data to say that it's completely off base at this point.
Scott, can we finish where we started, just on negative real rates? You looked at that from an asset allocation perspective, and that sounds like a relative trade. Scott, when do you think that relative trade is complicated? Do you have a number in mind as we start to drift back towards zero on real rates?
The way we're thinking about it is that when you look at any circumstance where real rates turn positive, right? Whether it's a 2% inflation, 2% GDP, 4% inflation, 4% growth expectation, what ends up happening is that the implication of real rates is that at some point in the marketplace, you're actually looking at an increased recession risk, right? So that's where it comes into the discussion. And then the moment you go down that path, it then begs the question of where do I want to be from an asset allocation perspective, stocks versus bonds. And there's a lot of moving parts of that discussion. It's evolving in different fashion than we've seen for some time. So I think where we're kind of essentially making the point here is that real rates appear to, as long as they remain negative, should be a net positive for underlying equity valuations. But as you go to a more positive real rate circumstance, then other alternatives, including cash, come to the fore and potentially crowd out flows into equities, which have been very strong even to start 2022.
An important moment for this market globally. Scott, great to catch up, buddy. Thank you very much for being with us. Scott Cronut there of Citi. As you go through the equity market and chop things up, get away from the index. The home builders all year to date, it's been a massive struggle. More recently, we've seen it in the transports as well. And when we talk about yield curve inversion, let's phrase this another way. Investors are willing to accept a lower yield on a longer dated bond than a shorter dated bond. That's what we're talking about here. And Tom, when you're talking about that, think about it. That tells you something about risk appetite, doesn't it? That if you're willing to accept a lower yield on a longer dated bond, that should tell you something about risk appetite.
Yeah, I thought Tony Crescenzi was really, really good on that the other day, the makeup of how we get the yield. And I would emphasize, John, the bid up and that price is moving much more than yield. To me, there's some, within the crises that we're in, there's some massive price dynamics. John, the satire here and agony of what we see in Ukraine is at full force this morning. You say, why is Mr. Putin like Mr. Putin? Vladimir Zhirinovsky has died, according to Associated Press. He was 75. John, he's the original theorist of Make Russia Great Again.
Boris Johnson this morning saying this to journalists: the killings in Bucha don't look far short of genocide. The View from the UK on the alleged war crimes, the pictures of which we all witnessed over the weekend. From New York City this morning, good morning.
Keeping you up to date with news from around the world with the first word, I'm Rishika Gupta. The US, EU and Group of Seven are preparing to impose more sanctions on Russia. That's after the discovery of those alleged atrocities in Ukrainian towns abandoned by retreating Russian forces. According to the White House, penalties will be increased on financial institutions and state-owned enterprises, plus sanctions will be placed on unspecified Russian officials and their families. Treasury Secretary Janet Yellen today will warn of the enormous economic repercussions of the war in Ukraine. Yellen testifies before a House committee. According to prepared remarks, she will highlight the risks of rising food and energy prices. Yellen will also make it clear the U.S. will not ease the economic pressure it is putting on Russia. This year's unprecedented bond rout accelerated after more hawkish rhetoric from the Federal Reserve. Fed Governor Lael Brainard said the central bank will likely reduce its massive debt holdings quickly. Bonds worldwide are extending those losses after completing an 8-month losing streak. That is the longest on record. JetBlue has offered to buy U.S. budget carrier Spirit for $3.6 billion. That potentially spoils a competing bid by rival Frontier, and it could reshape the landscape for ultra-low-cost air travel. Spirit says it will evaluate the JetBlue offer. 2 months ago, Frontier reached an agreement to buy Spirit for $2.9 billion. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
The war war in Ukraine rages on.
President Putin's invasion is brutal.
Turn to Bloomberg for up-to-the-minute reporting from around the world and analysis of what it all means to you.
The intention here is to increase the pressure on the sanctions front.
I think the United States policy is that the sanctions continue until President Putin is no longer there.
For continuing coverage from Ukraine and around the world, keep it tuned to Bloomberg Television and Radio.
At this critical point in the war, we must increase the pressure on Putin again and the Russian government. And this is why we propose to tighten our sanctions even further. The fifth package has 6 pillars. First, we impose an import ban on coal from Russia, worth 4 billion euros a year.
And the response to that is not enough. What else have you got? Ursula von der Leyen, the European Commission President, from New York City this morning. Good morning. Futures are negative 0.8 on the S&P, down by 1.36% on the Nasdaq 100. Yields are higher again, eating into risk appetite, up 9 basis points to 263.50 on a 10-year. We have some response from the UK and from Germany as well to the alleged war crimes. From Prime Minister Boris Johnson speaking to journalists a little bit earlier on, he said this: the Bucha killings don't look far short of genocide. Chancellor Scholz, Tom, saying the obvious, really, murdering civilians is a war crime.
Well, it's there, and the war crime debate is there, but that's a long-term debate, John. What are your thoughts on the short-term debate? To me, with fighting above the Black Sea, nicely inland, I mean, the war still goes on. We got to remember that.
Yeah, and we've got to focus on the what next to the policy response in terms of sanctions, Tom. It sounds like they're starting to have a conversation about things they weren't talking about several weeks ago. Oil and gas, in a way they weren't talking about those things, Tom. Coal at 4 billion. 4 billion?
Right.
Really? I mean, considering what they're saying, listen to the words that they're using, Tom. War crimes. Does that language, can you reconcile that with banning coal imports that are worth 4 billion? Come on.
In the blur of a war, there's a discussion here, but the idea of war crimes, and I even heard someone mention Nuremberg, I believe it was yesterday. John, those are discussions for another time and place.
Sure, I agree.
The atrocities are substantial. And again, we need to point out Moscow suggesting they are alleged. We'll see where that goes in the next couple days. We will stop Bloomberg surveillance and do so because the Anne-Marie Horton that you see ensconced at 1600 Pennsylvania Avenue is very different than the Anne-Marie Horton who was ensconced in London and traipsing all over continental Europe, leading the romantic life of international reporter. Part of that was Moscow. Part of that was the Moscow in London, and part of that was discussions with former oligarchs. She joins us this morning from the White House as we stop the show on Khodorkovsky. I hope I'm pronouncing that right. Anne-Marie, very simply here, you had an important interview. Did Mr. Khodorkovsky, he hasn't seen Putin in 18 years. He is the one that was pushed away. What are his thoughts on the present oligarchs?
Yeah, and he's been enemies with President Putin ever since. He last saw him 18 years ago. He spent 10 years in a gulag, and then he was freed. Mikhail Khodorkovsky has some really pointed words to the United States, and he's in Washington. He met with officials like State Department's Victoria Nuland and others, and NSC's, according to a State Department official. He didn't want to give names. But what he sees the situation right now is that the West does not see how the war is taking place the way President Putin does. Putin already believes he is at war with the United States and the West. It's just happening on Ukrainian soil. Sanctions every day. Training of Ukrainian military, sending weapons to Ukrainians. Putin views this as an outright war with the West. And then, to your point, Tom, on the oligarchs, he says that it makes sense, that is the right move, but under the wrong presumption, meaning it will not impact how President Vladimir Putin conducts himself.
Emery, I'm confused. Is his life at risk or injury? I mean, is he in a very compromised position here, meeting with Undersecretary Nuland?
Well, Khodorkovsky has been quite vocal since he left Russia. He has viewed Russia and wanted to view Russia and its future as a democratic state, a European democratic state, a Russia that leans into the West. And this is something that he basically is part of the reason why he went to jail, although Russia will say he was on tax evasion and fraud charges. So this is something that he has deep conviction and belief about. And even though potentially his life could be at risk, we have seen cases of the Russian state going after individuals in London, in Salisbury in the past. He still remains steadfast that he needs to speak out, and he does so continuously.
And Marie, there's one line from your interview with him that really stuck out for me, that Vladimir Putin thinks that NATO is weak and they will not defend the Baltics if Russia attacked those nations. How much is this actually the general feeling that NATO is going to be tested because Vladimir Putin is going to invade a NATO nation?
Well, we have heard from the president, a number of NATO leaders saying that Article 5, they remain by, and they will make sure they defend every inch, is the president's words, when it comes to NATO. But what Khodorkovsky says, and the view from the Kremlin, is that NATO is weak, and that Western Europe and the United States will not go to the rescue if Putin was to go into a Baltic country. And actually, this is a concern of those Eastern Europeans. When you hear the likes of leaders in Europe that want to make sure they're going after Russian oil and gas, who is that coming from? That is coming from Eastern European countries, because they are on Russia's doorstep and they are incredibly nervous. And this was the sense I got as well in Warsaw. In Poland, they are incredibly nervous. And Khodorkovsky talked about the fact that what Putin sees in terms of not this war already happening with NATO, it's a nuance to the West. They see it just happening in Ukraine, but he thinks it's all of Europe already. That is his mindset.
Anne-Marie, tremendous work. Awesome, as always. So looking forward to catching up with you in a couple of hours' time around the opening bell as we talk about some of those oil execs. Big oil going in front of a House subcommittee a little bit later this morning, I believe at about 10:30 Eastern time. We also need to catch up with the former New York Fed President, Bill Dudley, Tom Keene, and of course the Bloomberg opinion columnist. He's going to join us in about 5 minutes on his latest piece.
One of his most forceful pieces. There's been a set of them, and John, he doesn't mince any words of the ramifications of any set of 25 or 50 basis point rises. It dovetails nicely with what we heard from Lau Brainerd yesterday.
They've got to get restrictive, Bramo, and at this level, clearly they're not. And given where financial conditions are, clearly the idea of Bill Dudley is that they've got a lot of work to do.
I'm thinking about what Mr. Cronert said over at Citi just earlier, that if real rates turn positive, that's a game changer. And you really were pressing him on this, and rightly so. All of a sudden, cash becomes more appealing. Is that what the Fed has to do? Do they have to get real rates to zero? They certainly seem to be indicating that, or that's been the response in markets.
The VIX with a little lift again this morning, Tom. Just a little bit of a lift, a breakthrough 23.
Yeah, up there, 30 is the pain level, and, you know, we got to an 18 handle. We've come back 18, 19, John, to 23, and it shows that Dow futures negative 213. And, you know, I look at the, John, the Dow, 34,333 is, you know.
It's that kind of day. We're going to do Dow points and the VIX in percentages.
You know,
Is it that kind of day?
Yeah, it's that kind of day. I mean, the VIX is 23.
People watch this program, Tom. They listen to it because we don't do that. They can go somewhere else for that garbage. You know that.
Really?
Oh, this break is going to be fun.
Down 9/10 to 1%.
Nicely off 36,000.
This is Bloomberg.
Dr. Phil.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Away from the opening bell, equity futures declining by 0.9% on the S&P. On the Nasdaq 100, negative by 1.5%. Did a quick calculation early this morning. Since Chairman Powell started speaking 2:30 Eastern Time on March 16th, the Nasdaq 100 is up by 9.5% from that moment, even with yesterday's decline. Just think about that as we're about to catch up with the former New York Fed President, Bill Dudley, as he walks us through why he thinks that is part of a reason as to why this Fed has a whole lot more work to do. Two-year yields look a little something like this. Let's get to the bond market, 2s, 10s and 30s. Your 2-year picking up again, yields higher. Your 10-year, again, yields higher. And again, your 30-year yields higher. A 10-year, 260, 294. On a 2-year, 255, 10 yields higher there at the front end by 4 basis points. Where will rates be going? Deutsche Bank thinks 3.5% by next summer on Fed funds and perhaps 250 basis points worth of tightening from the ECB. Yes, you heard me correctly. The ECB by the end of next year. What could it mean? A sharp deceleration in growth for the likes of the Europeans and a recession by the end of next year for the United States, according to Matt Lazzetti and the team at Deutsche Bank. What does it mean for Europe? 250 basis points worth of hikes. Let's get to that story right now. Tom, let's look at the euro, look at the German 10-year, look at the Italian 10-year, and think about where that Italian 10-year would be at 233 right now if we had a positive 2% nominal rate, policy rate at the ECB from negative 50 out to positive 200.
And John, the problem with this is everybody quotes yield, including the financial media, and there's a point where price matters. And if you get yield up and Italian price down, what does that mean for Mr. Draghi and his work in Italy?
A complicated life, that's for sure. And Lisa, that's the problem the ECB's got, isn't it? If they go to 250, up 250 basis points of rate hikes, where on earth does that leave the debt market on the periphery?
This goes to the existential crisis in central banking in the developed world right now, and I know it's specific to ECB because of their difficult mandate with all the different nations. How do you hike into weakness? How do you try to tame inflation in the face of something that looks more constraining when it comes to consumer spending and, frankly, activity?
Looking forward to catching up with Bill Dudley in just a moment. That's the cross-asset price action. Let's get you some single names this morning. We can do that with Romain. Good morning to Romain.
Hey, good morning, John. Well, the single name moves today being dictated largely by the moves that we're seeing in the bond market. Combine that with the Fed minutes release a little bit later today, the prolonging of those Shanghai lockdowns, and, of course, energy prices still elevated. Stellantis and a lot lot of the automakers moving lower here for a second straight day. Some interesting commentary out of some of those companies, not only about supply chain constraints, but now you're getting speculation in the market here about further sanctions against Russia and what that might mean for some of the automakers that have a larger European presence there. NVIDIA shares down about 4% here in the pre-market as well, also on the back of some of those supply chain concerns and some new data that we got yesterday showing that the length of time to deliver a chip has actually gotten wider, not narrower here. And then, of course, we're going to have executives from the major oil and gas companies on the Hill today here. Chevron shares and most of the shares of these companies are higher here on the day, of course, on the back of those elevated oil and gas prices. And, of course, that's the big problem that Congress has with a lot of these folks. I went through the prepared testimony for a lot of these CEOs. Mike Wirth over at Chevron, I thought, made a really impassioned plea here, trying to make the case here in that prepared statement that these companies don't have as much power over pricing as members of Congress seem to think they do. They also said they would pledge to try to do a little bit more when it came to production, as well as some issues with regards to refining. So keep an eye on that space. Also keep an eye here on what's going on in Washington and regulators who are going to be coming into work today. And I really have to chew over this bid that JetBlue is making for Spirit Airlines. This is a big deal here. Remember, JetBlue has already been in a fight with the Justice Department over its alliance with American Airlines, an alliance that some members of the DOJ have basically said amounts to a merger. Remember, they're actually taking JetBlue to trial later this year on that. And then, of course, the Spirit deal with Frontier that had already been in the works prior to the JetBlue deal, that had been widely criticized by a lot of the more liberal members of Congress, including Elizabeth Warren, who basically said that it just could not be done. JetBlue, we should point out, Mary Schlangenstein, our Bloomberg reporter for airlines, did interview the CEO of JetBlue, Robin Hayes, and Robin Hayes did say, in his words, that there is a compelling argument that a tie-up between JetBlue and Spirit would actually lower fares. Tom, nevertheless, shares of both of those companies lower here in the pre-market.
Roman Bostic, thank you so much. In 1982, if you get said parchment from Berkeley, you enjoyed the breaking of the Volcker inflation, maybe 8%, maybe 7% inflation at the time. William Dudley, of course, went on to Goldman Sachs and then on to his public service at the New York Fed, and we're thrilled that Dr. Dudley could join us this morning. We've got a lot of questions, Bill, off your important essay. I'll let John and Lisa get to that. Define the difference between Volcker and Brainerd inflation. What's different with this 7-8% versus a 7-8% when you were certified at Berkeley?
I think the difference is that the inflation that Volcker had to fight built up over a long period of time. And so inflation expectations started to rise pretty significantly. So it's much harder to get rid of the inflation than the inflation we have now. The good news is that the inflation expectations are still relatively well anchored. So that would imply that the Federal Reserve isn't going to have to do quite as much to push inflation back down.
Your line in your piece this morning in the lead paragraph, Bill, I think has got everyone's attention, so I'll repeat it for everybody who hasn't heard it so far. To be effective, it'll have to inflict more losses on stock and bond investors than it has so far. Bill, run us through financial conditions and how you gauge financial conditions and why you might believe that stocks are a big part of that.
Well, financial conditions are important in the United States, and Chair Powell has emphasized this in his prepared remarks. Because that's how monetary policy works. The U.S. economy doesn't really run on short-term interest rates. It really runs on long-term interest rates. And the stock market is also important because a lot of people have exposure to the stock market, and the level of the stock market affects their wealth. So the Fed has said pretty clearly, we need to tighten financial conditions to slow the economy down to keep inflation in check. And so far, financial conditions really haven't tightened very much. The stock market is only 4% or so off its high. It's still up very sharply from where it was a couple of years ago. And bond yields, 2.5, 2.6%, are still really low, especially when you adjust for inflation. So in my mind, the Fed hasn't really accomplished much yet. And if financial conditions don't cooperate with the Fed's going to have to do more until financial markets do cooperate.
Bill, talk a little bit about the consequences of this. If stocks are a reflection of sentiment, if they affect the way that people are willing to go out and make purchases based on their household wealth, what does that do to the economy? Are you basically saying that if things continue the way they are, the Fed is going to have to torpedo growth to a potentially recessionary degree?
Well, the Fed right now is, markets are pretty confident in the Fed's program because they have the Fed taking the short-term rates up to about 3%. That causes the economy to slow, and then the Federal Reserve eases policy in 2024 and 2025, and we have a soft landing and live happily ever after. I don't think it's going to be that easy. because the markets are so confident in the Fed, the financial conditions are still quite buoyant. If financial conditions are buoyant, that means the Fed has to do more to slow down the economy. Also, a soft landing is very, very hard to achieve when the unemployment rate is so low. The soft landing examples that Powell has cited, 1965, 1984, 1994, were all examples where the Fed tightened and the economy slowed, but did not slow sufficiently to push up the unemployment rate. The unemployment rate in all three of those episodes kept declining. I think in the current environment with the unemployment rate at 3.6% and wages running well above a rate consistent with 2% inflation, the Fed's going to have to tighten financial conditions enough to push up the unemployment rate. And when the Fed has done that in the past, it's always resulted in a recession. That's not their intention. They'll go for a soft landing, but their chances of pulling off are very, very low.
Do you think that rapidly reducing the balance sheet, Bill, will be enough to achieve this sell-off that you think is necessary in order to enact some of the tightening that the Fed is trying to achieve?
Well, certainly we'll work in the right direction. Obviously, quantitative easing helped pull down long-term yields, and I think as you reverse course, that should push them up. But we don't know by how much. We already know what the Fed's going to do, and markets haven't really moved very much. So, I think it's just a big wild card in terms of how much will the quantitative tightening do the Fed's job for them. I think the big point I would just make is just it's very unlikely that a year from now we're going to be at this level of bond yields this low and this level of stock prices this high, because that's probably not sufficiently tight financial conditions to do the Fed's job for them.
Bill, parse the difference as inflation comes down of the importance of goods inflation coming down versus service sector inflation coming down.
Well, obviously both matter. I mean, I think where the Fed's expectation is that goods inflation will come down quite a lot over the next year, because the composition of demand as the economy reopens will shift away from goods back to services. And the fact that some of these supply chain disruptions, for example, in the auto sector, will gradually get resolved. And so car prices, for example, will be weaker, used car prices will be weaker. But the services sector inflation is going to be a lot more persistent, because that's really about labor costs. And we're seeing that labor costs are going up because the labor market is unusually tight in the current setting.
Bill, why don't Fed officials, when they're in the seat, talk like you just have now?
Well, it's unpleasant to be a Fed official and talk about how you have to tighten financial conditions to push up the unemployment rate. You don't want to talk about putting people out of work. And that's not obviously the deliberate goal of policy. The deliberate goal of policy is to keep inflation from getting out of hand. Unfortunately, one of the ways you have to do that is to generate enough slack in the labor market to keep inflation in check. And that's just an unpleasant conversation to have. So what the Fed officials talk about is how we have to keep inflation in check so we can sustain this economic expansion and keep the most number of people employed. And that's true too. What they're not telling you, though, is how difficult that is to pull off.
Bill, a clinic, as always, and we appreciate your time this morning. Bill Dudley there, the former New York Fed president and, of course, amongst other things, now a Bloomberg opinion columnist. The title of his piece this morning, Tom, if stocks don't fall, the Fed needs to force them.
Well, the force is the key word there. It's a horse in the cart. I mean, what gets out front here? And I would suggest that, the people that would push against Dr. Dudley, like Dr. Blanchflower up at Dartmouth is one example, would say horse in cart, and who pushes who? And will corporations and the markets react ahead of the Fed is the big debate.
Well, I can tell you equity markets are reacting now. Another leg lower on the S&P.
Yes.
We're down 0.9% on the S&P. On the NASDAQ 100, we're down 1.5%. Yields are higher by 8 basis points on the 10-year to 262.94. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. An ex-oligarch says that from Vladimir Putin's perspective, Russia is already at war with the US and its Western allies. Mikhail Khodorkovsky was once Russia's richest person. The exiled oil mogul told Bloomberg that because of sanctions and arms shipments to Ukraine, Putin views Russia as fighting the West on Ukrainian soil. The European Union's foreign policy chief called a summit with China's President Xi Jinping a deaf dialogue. Joseph Borrell said China didn't want to discuss the war in Ukraine. That cast doubt on how much cooperation Beijing will offer to end the fighting. And a veteran Hong Kong law enforcement official plans to run for the city's top job. John Lee's announcement is a sign that Beijing wants to deepen its crackdown on dissent. Hong Kong media report that China's liaison office has told local elites that Lee has Beijing's blessing to succeed Carrie Lam as chief executive. BNP Paribas has reached one of the most comprehensive work-from-home deals amongst major banks. More than 132,000 employees of the French lender had the option of doing their jobs from home for up to half the week. Banks in Europe have been adopting flexible arrangements to boost morale and save money. Twitter will kick off internal testing of that edit function in the months ahead. The company said work on the button started last year before any online poll. Tesla CEO Elon Musk started that Twitter poll Monday asking if users wanted an edit function. That came just hours after it was announced that Musk has become Twitter's largest shareholder. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Everyone you meet in Port Harcourt has stories about what they call black soot, caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes, have to give way to oil wells. No one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question. Great question. Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
For the euro area, the financial stability impact of the war has so far been relatively contained. Markets have generally been functioning well, while both banks and non-banks have been affected, especially the few that have large direct exposure to Russia and Ukraine. The economic fallout has not had a sizable impact on the EU banking or financial system as a whole.
The words of Luis de Guindos there, the ECB Vice President. A difficult moment for the Europeans and for policymakers too. From New York City, good morning. Futures are negative on the S&P. We're down by 0.9%, off by almost 1.5% on the Nasdaq 100 as yields climb higher once more, up 8 basis points on a 10-year to 263.13 on a 10-year yield this morning. Quick look at crude, a 103 handle, just about, up a little more than 1% on the session. This from President Zelensky of Ukraine, Tom, this morning, warning that the Russian leader, Vladimir Putin, his ambition has not changed. In his words, still to occupy all of Ukraine. It remains undiminished as his forces continue to strike fuel storage sites and grain silos too. Tom, that last point is going to be a big issue.
Yeah, there's no question about it. And as I've emphasized this morning, folks, within all the talk and the media splash, this war continues. Let's get right to it. This is too important of a conversation and is truly extraordinary. Evelyn Farkas and her family are out of Hungary. They know the experience of moving out of continental Europe over to America with her tour of duty at Franklin and Marshall College and then her PhD at the acclaimed Tufts University Fletcher School. What is fascinating is in her public service to President Obama, she is now on the same page as John Bolton. That is extraordinary. And Evelyn, we had John Bolton on the other day, and both of you say, get over it. We're not going to start World War III. Discuss what America can do amid this fear that we have that, OMG, we're going to have World War III.
Well, I mean, I think, Tom, to the point that what I've been arguing, and I had a Washington Post op-ed about this, and I've been running around, I guess like John Bolton, not with my mustache on fire, but my hair on fire, trying to explain that we shouldn't let Vladimir Putin deter us. Yes, unfortunately, he has used chemical weapons and he has a lower threshold for nuclear use, but he does not want war with NATO. So we should really calculate the risk that we are willing to take in order to protect civilians. And I think me and several colleagues of mine who are national security and foreign policy experts, we signed a letter saying that the administration should not dismiss the idea of a humanitarian no-fly zone completely out of hand. And what we're trying to do there is say, do not rule things out. We need to be agile and we need to understand that we may need to do more, take on more risk to save lives. And so I'm worried as we move into the next phase of the fighting that we aren't thinking enough about how to save lives. We are providing additional military support, and that is really important, and that should continue.
I look, Evelyn, at the path forward, and we are shocked by these atrocities. I don't want to get into the debate of the war game, but I want to know from you how a Pentagon, or the Pentagon in Germany, or the Pentagon in France, how they respond to the horror that we've seen.
Well, I think everyone is horrified, and the question now is what can be done. In the past, even in brutal wars like the Balkan Wars in Bosnia, I lived there after the war, we have had international agencies in there providing humanitarian assistance and trying to prevent the kind of massacre that happened in Bucha and elsewhere. And I would like to see some of these multilateral institutions like the Red Cross taking more risk, maybe going in with armed escort. They were held back more than 24 hours from rescuing citizens, innocent civilians from Mariupol just this past week. So more needs to be done. Certainly other countries need to be pressured to put pressure on Russia to allow for civilians to be evacuated. But unfortunately, what we see here is that Russia is purposely trying to slaughter civilians. It's part of their effort to try to break the will of the Ukrainian people and the government.
Evelyn, how do you see this ending?
Well, of course, I'm hopeful that the Ukrainians can, frankly, take back their territory and beat the Russians on the battlefield. I don't think sanctions are going to destroy Vladimir Putin's intentions here. I mean, his aggressive foreign policy will continue, and sanctions will take a longer time to have an impact. So really, it will be determined on the battlefield. If we can provide sufficient or enough, I mean, sufficient, I don't like the word, but if we can provide the military means necessary for Ukraine to push back the Russian military, there's a chance that they can regain their territory. Other than that, there is a compromise potentially where the Ukrainians might have to give up some territory, but I don't see that happening anytime soon.
Evelyn, a personal question. Your father has been definitive on the collapse of the Hungarian aristocracy and the time from another place, even before Stalin and Hitler. I am fascinated how you believe we can explain to the Russian people that Ukraine doesn't need denazification. Your family lived Nazification. How do we explain to them that we don't need to denazify Kiev?
Well, this is a problem. I mean, the Russian government has a lot of control over its population through its monopoly on the media. They do have a lot of internet saturation in Russia now, and so some people can get alternative news and truth, but that's also being increasingly squeezed out. And yes, my family, I was born in the United States, but my parents both fled communist Hungary. And as a child, I went back to Hungary to visit my grandparents. I spent summers in Hungary. I know what it's like to live under communism when you can't speak the truth and being told as a 10-year-old to be quiet because I might get my grandparents in trouble. And by trouble, I understood it meant jail and something pretty serious. So you know, the Russian people, we don't really know exactly what they think, even when there are polls that are taken. Those are probably somewhat suspect. But unfortunately, the brainwashing is pretty effective. It's going to take, frankly speaking, the Russian soldiers coming home or not coming home for the Russian people to start to figure out what actually their government is doing in their name. So as I said, the home front in Moscow, in Russia, proper is not really where the war is going to be determined. I think it's really going to be on the battlefield.
Evelyn, thank you, as always, for joining us. Evelyn Farkas there, the former Deputy Assistant Secretary of Defense. Tom, getting a read on what's actually going on in the country right now is pretty hard.
Well, it depends which country it is.
I'm talking about Russia specifically.
No, Ukraine as well. But John, to your important point, in Russia, it's a complete mystery. The most sophisticated people I know are saying, the most in touch people I know are saying it's not that it's this or that. We just don't know the structure. I will say the tone is that Mr. Putin has in some way a large support of the Russian people.
They are being force-fed propaganda, and to Evelyn's point, Tom, it would take people coming home, or rather not coming home, to perhaps open people's eyes to what's been happening.
Well, I saw a number yesterday of 40,000 dead and injured. I have no idea if that's a valid number, but as those numbers climb by the 10,000s, you're dead on, John. No pun intended. It's going to be a message to the Russian people.
A bit of a sell-off this morning, down almost 1% on the S&P, on the Nasdaq 100, down by about 1.5%. Lee Ferridge of State Street is going to join us shortly. Looking forward to catching up with him as equities correct a little bit lower. This is Bloomberg.
nuestro estudio, nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes, según las modificaciones nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Leading indicator we have of the economy tells us that it's heading sharply lower in the next 6 months.
The idea that growth is going to slow, I don't think that that's debatable. I think where it is debatable is the degree to which it slows.
The U.S. equity market tends to be the strongest when things are weakest globally.
The thing to do throughout all of this is to really apply good old-fashioned common sense investing.
As we get to the end of the year, I think the picture's going to look a lot different.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television. It is an eventful Wednesday. Dare we say it's a rapid pace Wednesday. The tone, the second derivative, the calculus from the lady from Wesleyan, Lael Brainard, moves markets yesterday. John, they continue to move this morning.
That line from Governor Brainard, we need to start to reduce the balance sheet at a rapid pace as soon as our May meeting. Chairman Powell said basically the same thing on March 16th. He said look for the Fed minutes, and this afternoon, Tom, that's exactly what a few of us will do. We'll look for the Fed minutes.
You've been featuring through this morning this illusion as we talked to Bill Dudley about what's the difference between the Volcker inflation and the Brainard inflation. And to me, it's just the intertwined nature of all this with the pandemic, with that huge fiscal stimulus. And I'm going to suggest, John, a massive mystery between Bill Dudley and David Blanchflower just as one debate.
Everything in between, Tom. And everything, all of the above of what you've just said. We're moving quicker, much, much quicker. Balance sheet reduction is going to happen faster because rate hikes haven't come soon enough. Think about how this worked out last time around. The hike started in 2015. The balance sheet reduction started 2 years later. This time around, there is not years between. There is about a meeting, not even. It's a couple of months, Tom. That's the change this time around. And they believe you can go faster because this economy is stronger. Will this economy hold up as we push through the rest of this year?
Next trip for Abramowitz folks, out to LAX, into the Hummer H3, and up to Mammoth Mountain. Lisa Premium in Mammoth Mountain, over $7 a gallon right now. That'll be a topic in Washington.
Yeah, called what? Gas gouging or something that they're doing?
No, that's
with
just the price. No, it's the price.
But this is the issue, right? We're going to get the Democrats in particular in this House subcommittee hearing that we're expecting to start at around 10:30 a.m. John Farrow will be watching it with popcorn as you get these oil executives coming in front of Congress to be absolutely raked under the coals at the same time that we need them to produce more to get those prices down.
John, I mean, this is so important. Our prices are getting somewhat like your prices in England. Would you have oil executives in London go before the House of Commons about gouging, etc.?
Yeah, I think it's fair to say the conversation elsewhere is different to what we're experiencing here in America. And to go over that title of the House subcommittee hearing today, gouged at the gas station, big oil and America's pain at the pump. If you wanted something productive out of this morning at 10:30 Eastern time, I think based on the title of this hearing, it's unlikely we'll get anything productive.
Well, we'll have to see, and of course, we'll have a lot of good coverage on that with Anne-Marie Horton in Washington and our wonderful hydrocarbons team as well. John, we've got to do the data. I'm going right to the fix over two big figures of damage this morning, 23.34 in the VIX.
We've got to start with the bond market. Yesterday, up 15 basis points on a 10-year. Close to 255 through that level. Then we closed at 254.69. Then this morning, boom again, up another 9 basis points at 1 point through 265, up 9 right now to 264, Tom. Just a monster move on the Treasury yield through the curve over the last few months.
I want to focus also, folks, quickly. We're not going to spend much time on it, but the Russia of 2042 is front and center in international finance today. A real question about how Russia will make those payments. An ongoing story here at Bloomberg. Right now, Lee Ferris joins, head of macro strategy for North America at State Street, as he and we recalibrate to the news flow. Lee, what is new in your analysis with all of these stories, these emotions, this tough news from Ukraine? How have you readjusted?
It's tough, Tom. I mean, yeah, the narrative changes all the time. I mean, obviously, the focus now, we've been focused on rate hikes for all year so far. And now suddenly, after yesterday's Brainard speech, it's all about QT. How fast? When do we start? How quickly do they ramp it up? Is this as well as rate hikes? Does this replace some rate hikes? This is the debate that's going on over the last 24 hours. I mean, it's not about rate hikes. Your rate hike expectations haven't moved over the last 24 hours. It's all about QT. That's what's driving things.
Lee, before we try and predict the future, can we talk about the last 3 weeks? This is exactly what Chairman Powell said at the last news conference. He said, look to the Fed minutes, we're going to have to move quickly. And the NASDAQ rallied about 10% on the NASDAQ 100. What was the last 3 weeks about?
It's a really good question. Yeah, I mean, I think the market had taken the sort of QT argument. They were expecting June, and I think the view was that it was going to be more gradual than we now think. So the market was looking at, okay, so we're pricing in maximum rate hikes. 10-year yields are still around 2.5, below 2.5 they were. So real yields are still significantly negative. That gives me a reason to buy equities. That gives me a reason to buy duration because the peak in rates will still leave real rates negative. You throw in a much more aggressive QT, suddenly that equation starts to change. And then you look at real rates now, 10-year real rates minus 25 basis points, that's going to start to hurt.
But Lee, the reaction function, and we've been talking about this debate in the bond world, whether longer-term yields actually go down as a result of quantitative tightening, not go up, as so many people seem to think, at least as it plays out in the bond market. Where do you fall on this?
It's a good question. I think initially they go up, right? I mean, you've got supply. It's the opposite of QE. QE flattens the curve. QE drives down longer end rates. QT, if we look back to 2018 when we last had QT, you saw rising rates until equities cracked. So we rose in the first quarter, equities sold off February, March, rates sort of stabilized, and then we went higher and we hit 1% real rates in Q4 of 2018, 10-year real rates of 1% in Q4 2018, and we saw that massive equity sell-off, which the Fed backed away and the whole world changed again. So really, you do get upward pressure on long end rates, and then you see equities sell off, and that brings longer end rates down again. But there's a there's a push, there's an upward pressure on them to start with.
If I had asked you a year ago, Lee, at what point bond yields would have to go before stocks cracked, probably it would have been way south of 260, right? So at what point here, based on some of what's being expected in earnings, what is the level of bond yields necessary, in your view, for that cracking?
Well, as I said, if we look back at 2018, it was really when real rates got towards 1%. So we're still negative 25 right now. I think this time around, the sort of the level is lower, valuations are higher in equity markets, and things are more nervous, and we're fighting this inflation issue at the same time, which we weren't last time. So real rates positive, maybe plus 25 on real rates. That probably does it. That puts us, around 3.25, pretty much nominal where we got to last time as well. So that sort of level, I think, is where equities really crack. Although there might be more concern this time, there is much more uncertainty out there this time. You throw in, the inflation level, you throw in the inversion of the curve we're already seeing, you throw in Ukraine, that nervousness is higher all the time. So I don't think it's going to take 1% real rates this time. Probably positive real rates at the 10-year, but maybe not even as high as 25 basis
points. We're not far away. So, Lee, I think there's a lot of people listening to this thinking about what they should do with their equity exposure. Is it a wholesale reduction across the board? We've seen some of the weakness appear in the economically sensitive parts of the equity market, in the home builders. We've seen it there in the transports more recently. Lee, what should they be doing?
I would be reduced. I mean, I'm naturally a bear. I'm a bond and an FX guy, so I'm naturally bearish on equities. It's just the way I am. But I would be, I would be really looking at it. I'm not sure we've seen the lows in equities this year. I know we had that bounce in March. We sort of, we backed away. There is no alternative. Real rates are still negative. But, we're now seeing QT front and center. And if they do start aggressively, if they do start at, say, 40 billion, 50 billion a month, which is feasible, then that's going to be a lot to swallow. And that's going to push real rates positive fairly quickly, I would imagine. And that's going to be bad news for equities across the board. And you think back to late 2018, there was no sort of, there was no discretion here. Everything went down. And that's the playbook you've got to start looking at in this environment. That's the only QT playbook we have. That's the one you've got to start looking at.
Why are things so depressing on these bond desks when you're a kid, Lee, and you grow up to be a bear and everything? What's this all about? Lee Ferridge of State Street.
Didn't even let him respond.
He can if he wants. Lee's still there. He's got a hot mic. Lee, go on.
Jonathan, it's being English, right? It's English and an economist, right? It's a deadly combination. An English economist is the most pessimistic combination you can get.
There we go. Buddy, it's going to catch up, as always. Lee Ferridge there. Bramo like that.
Well,
I know that for sure.
That's why you like to tweak me, because you personally empathize, clearly, because you're also British and, you favor economics. There you go.
Of course.
There you go. So,
Being in London as well, getting exposure to the Lee Ferridges of this world. Just gives you that kind of worldview. Tom, equities down 1% on the S&P, on the Nasdaq 100 down by 1.6.
Yeah, it's a weight. I don't know. It's a weight, but I'm going to take your point, John, of 2 big days back to back in yield. One would be enough, but the fact is, off the move yesterday, the move today, where are we? We're at 9 basis points in the 10-year yield. And I want to make clear, this isn't an inversion story, folks. This is a lift to the curve, a complete reset off of QT.
Elisa asked the right question. She always does. She always does.
Really?
Does QT mean higher or lower yields? And Lisa, we've gone over it a couple of times, haven't we? Divided. The debate is divided on that.
And the question is, do yields have to go up first, and then they come back down when the necessary turmoil takes place?
Coming up on the program, looking forward to catching up with the Senator Bill Cassidy, the Republican from Louisiana. We'll do that very shortly. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. The US, EU and Group of 7 are preparing to impose more sanctions on Russia. That's after the discovery of those alleged atrocities in Ukrainian towns abandoned by retreating Russian forces. According to the White House, penalties will be increased on financial institutions and state-owned enterprises, plus sanctions will be placed on unspecified Russian officials and their families. Treasury Secretary Janet Yellen today will warn of the enormous economic repercussions of the war in Ukraine. Yellen testifies before a House committee. According to prepared remarks, she will highlight the risks of rising food and energy prices. Yellen will also make it clear the U.S. will not ease the economic pressure that it's putting on Russia. This year's unprecedented bond rout accelerated after more hawkish rhetoric from the Federal Reserve. Fed Governor Lael Brainard said the central bank will likely reduce its massive debt holdings quickly. Bonds worldwide are extending those losses after completing an 8-month losing streak. That is the longest on record. And speculation is being raised about Russia and a potential technical default. Russia's finance ministry paid rubles for some of its dollar debt obligations due this week. That's because foreign banks refused to process $649 million of payments, but the securities didn't give Russia the option to pay in rubles. And Lazard says 2 of its top executives will step down this year. They are Asset Management Chief Ashish Bhutani and President Alex Stern. Bhutani's operation oversees more than $250 billion. He'll be succeeded by Lazard's CFO, Evan Russo. Global News 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
The war in Ukraine rages on.
President Putin's invasion is brutal.
Turn to Bloomberg for up-to-the-minute reporting from around the world and analysis of what it all means to you.
The intention here is to increase the pressure on the sanctions front.
I think the United States policy is that the sanctions continue until President Putin is no longer there.
For continuing coverage from Ukraine and around the world, keep it tuned to Bloomberg Television and Radio.
We're still bullish on oil post the SPR announcement. We see oil trading up to $125 a barrel. I want to emphasize that what this ultimately does is it crowds out more investment. It makes this long-term situation worse because SPR release is not a long-term solution to underinvestment.
The view of Jeff Curry there of Goldman Sachs, the global head of commodities, his call still 125 on crude. Equity futures this morning, and good morning to you, are negative by about 1% on the S&P, on the Nasdaq 100 down by 1.6. The bond market eating into the equity market gains of the last 3 weeks. Yields up again by 7 or 8 basis points. A move of 15 yesterday, 262.19 on a 10-year. A little bit higher than that now. On crude, a 103 handle, 103.30. Crude is up by 1.28%. There is a House subcommittee hearing on oversight and investigations of the Committee on Energy and Commerce. And the title of that, Tom, a little bit later this morning, Gouged at the Gas Station.
Gouged at the gas station.
Big oil in America's pain at the pump. I mean, it's not a joke, but the title might be, Tom.
Well, there's the title, and that will be the emotion, and we will look at this from the oil patch now. With Dr. Cassidy. Bill Cassidy is from Louisiana. He is a force in Baton Rouge, winning 59% of the vote in 2020. Senator Cassidy, thank you so much for joining this morning. Before we dive into the clear and present gouging, I need to talk to you about the distance from Detroit and the Democrat Debbie Dingell and John Dingell out to Kalamazoo on Route 94 and Fred Upton. Fred Upton retired yesterday, almost in tears, from the Senate because he's being pushed out by the Trump part of the GOP. You lived this. You had a nice reelection in 2020. Can you comment on the GOP vendetta against those that said we need to impeach the president?
Well, first, Fred was redistricted in a tough way. He lost 350,000 of his base voters. Now, there are some in the party who are mad at folks like Upton, mad at folks like me, who voted for impeachment. That's just the way it is. You do what's right, and you live with it. And I think Fred is incredibly proud of the integrity that he showed with that vote.
With the enthusiasm that we hear and suggest that the Republicans may take the House, indeed the Republicans may take the Senate, what does the new majority Republican Congress need to do day one?
Yeah, day one, we need to start going after inflation. Inflation right now is being driven by energy cost, both direct, the cost of the pump on your fuel bill, but the indirect, the inputs to the fertilizer that go to the crops, that's a lot higher now as well. I proposed an Operation Warp Speed. Just like we took the vaccine and within 10 months had something predicted to take 2 to 10 years, we should take a regulatory kind of, let's get it all together and figure out how we can increase supply and decrease prices for us and our allies within 10 months, if not shorter. We can do that, but we need the regulatory agencies. We need an Operation Warp Speed.
Senator, where do you see this fitting into eventually moving away from less of a reliance on fossil fuels?
Yeah, so right now, believe it or not, there is a regulatory uncertainty for renewables. There's a regulatory uncertainty for carbon capture, utilization, sequestration. So what I'm speaking of is not just oil and gas. It is also the CCUS that Louisiana has been waiting for Region 6 EPA in Dallas to get off their duff on our application since October of last year.
Are you saying... Excuse me, Senator, are you saying basically that it could just be a regulatory fix that could plug the hole, that could plug the gap in some of the supplies that we're seeing, at least in part stemming from Russia?
It could be a regulatory fix as well as regulatory certainty. Right now, it's death by 1,000 cuts to fossil fuel. So why are you going to invest when OPEC may decide to collapse prices and you're left with regulations, which, et cetera, et cetera? So my point being that if you could have regulatory certainty, have a little bit of capital injection to kind of commit the federal government, yes, you oil field service providers, we're not going to leave you out hanging bankrupt, then we could rapidly improve, increase production.
Bill Cassidy, you own the high ground on this, and today it's going to be big oil that's going to talk about price gouging and that, but you live it in Donaldsonville, Louisiana, with CF Industries, the largest nitrogen fertilizer company, I believe in America, maybe in the world, I'm not sure on that. Explain to us how the people in Donaldsonville aren't price gouging fertilizer.
Yeah, so natural gas is a feedstock for fertilizer. And so if your inputs rise, then it's going to increase the cost of the final product. Now, there's also the ability to ship. There's also other aspects of the logistical supply chain. Obviously, it costs more to maintain your plant, costs more for labor because of general inflation, but that's just going to be a little bit of a gap.
Yeah.
Now, you could sell it below price, in which some middle person is going to buy it and then sell it at the market rate, but in somewhere there's going to be a markup.
Senator, amid this soup of information, the soup of concern around gas prices, how concerned are you, or how upset will you be if you see oil companies post gangbusters profits in the next earnings season?
Well, you want to look at the reason for their profit. Let me just say that. And if they're going to use that profit to turn around and invest in the new fields that we need in order to increase production, well, isn't that a good thing? And let me point out, about, I don't know, a year ago, people had to sell their oil at a below zero price. There was no storage. They had to pay people to take their oil. So there's always going to be some rises and falls. What you want to see, though, is the capital investment that long-term creates more certainty in terms of our fuel supply.
Senator Bill Cassidy of Louisiana. Senator, thank you for being with us today. Lisa teeing up earnings season a little bit later this quarter. We get earnings season for the Q1 story on the 4th of May from Pioneer Natural Resources. That could be interesting, couldn't it?
It's going to be fraught.
Yeah. I don't know, it'll be interesting to see. Excess profit tax, we've seen it all before. John, can I do a quick surveillance correction? I misspoke. Al, watching in New Jersey, I didn't even know Al knew the map of Michigan. But Al in New Jersey, thank you so much for emailing in and watching Bloomberg Surveillance 5 days a week. John, Al notes out that I said Fred Upton in the Senate, and of course, Congressman Upton is from Kalamazoo and in the House.
Al, there we go, Tom. And Al from New Jersey listens, does not watch.
We're up to 12.
It's a radio story.
Oh, yeah, he listens. I didn't know that.
Listens to
Excuse me.
Listens to it religiously too. Loves it. It's in love with it, Tom.
Nice catch.
This banter, can't get enough of it. Futures down 9/10 to 1%.
Al watches the Dow Jones Industrial Average.
On the Nasdaq 100,
down
by 1.5. Where is it, Lisa?
The Dow?
You.
Yeah,
Yields up by 6 basis points.
319.
261.25. I'll just talk over that. Heard on radio, seen on TV. This is Bloomberg Surveillance.
We know that it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
It is yesterday on repeat with equities down and yields higher from New York City this morning. Good morning. Equities on the S&P 500 negative by 0.9%. On the Nasdaq 100 negative 1.5%. Here's your move in Treasuries. Down, yields up by 7 basis points, 261.81. And your next stop, Fed minutes a little bit later. Lisa, what time?
2 p.m.
2 p.m.
I always think of 2:30 because that's the press conference, and I feel like this is equivalent to a press conference.
It's that big.
It's that big.
2 p.m. this afternoon. So. What's on your schedule for this afternoon?
I'm walking vet bill.
Usually that's when I get the call and you're smoking a cigar.
Got that right. Walking vet bill.
Time. How about I read the minutes for you, Tom, and
you can
we'll
read
have
it
our
for
phone
me.
call later,
Put me
okay?
off to sleep with a beverage of my choice. Right now, and this is a joy with futures negative 40, the VIX out 2 points. With Michael Collins, he's at PGIM. And what's cool for our global audience is the State University System of New York. And in my youth, everyone knew the most prestigious math program was If You Could Survive It at Binghamton, New York. Michael Collins survived mathematics at Binghamton, which is a big deal when we were growing up. He's senior portfolio manager again at PGIM. Mike, buried in your mathematical note is the economic bet of PGIM that the wage spiral or the wage worry, including what Bill Dudley saw in the last hour, may ebb away. Do you see evidence of that yet?
You're just starting to see, Tom, the wage growth and the labor market growth start to flatten out here and maybe start to roll over. You see it in hours worked in the report we got on Friday. So I think you have probably passed the peak rate of growth in wages, right. Certainly the peak rate of inflation, I would argue as well.
You're going on calculus on us like Lyle Brainerd did yesterday when she talked about the rapid pace, let's call it the second derivatives in these markets. How do you actually prosecute bond management given the rate of change right now?
Yeah, well, we all know, Tom, that the markets really do focus on second derivatives, right? And it's the change that really matters more than the stock, right? When it comes to quantitative tightening, for example, a lot of people will look at, well, the balance sheet is $9 trillion, so it goes to 8.5. What's the big deal? It is a big deal, right? When the Fed embarks on quantitative easing, you see a super high direct correlation with asset prices going up. So what we're contemplating in our shop, Tom, is when they do quantitative tightening, do you get a symmetrical pullback in asset prices, or is it more measured as the Fed tries to signal that quantitative tightening is watching paint dry and it's on autopilot and it's not going to be a big impact on the markets? But I do worry that it will result in much tighter financial conditions.
So let's, since you walked right into the big debate of the day, does quantitative tightening cause higher, longer-term bond yields or lower ones?
Yeah, it's the opposite of what everybody thinks, right? By the time they start the quantitative easing, right, typically rates have plummeted, you're in a recession, it's a big risk off, and what happens when they start buying bonds? Rates go up because what they're trying to do is get inflation higher, and it's going to be the exact opposite when they do quantitative tightening. The markets have already priced in. Look where rates are, right? Look where inflation expectations are. They're kind of peaking here. So by the time they start tightening policy through rate hikes and simultaneous quantitative tightening, which we've never seen in our lives, right? This kind of quick reversal of monetary policy on so many fronts, I think you're going to see a peak in rates at that time.
So a peak in rates at that time. Are you buying 10-year treasuries at this point, saying 2.6% looks golden over the long term?
Yeah, I mean, fortunately, we had cut duration earlier this year, and we were short duration marginally in the U.S. and just really in the last week or so, we've covered in most of that, and we're kind of flat duration. I mean, there can be a better entry point. I mean, personally, I'd love to be, long duration at some point over the next, few months or few quarters. But at this point, we're just kind of waiting for the right entry point, and it will come, right? And it typically comes right around the time the Fed starts tightening policy aggressively, and they really haven't started that, right? And they're going to start in earnest really soon.
Michael, the movable feast, which is the terminal yield or the terminal dot plot, has an x-axis and also a level. What's the level of the 10-year yield, and how far out is that terminal yield right now?
Yeah, it's really fascinating, Tom, to look at what's happening with forward rates, what the market is pricing in. The markets are basically pricing in a funds rate right now in like a year or year and a half of close to 3.25 now, right? So 300 basis points almost of incremental hikes. But a year and 2 years and 3 years after that, the markets are pricing in almost 100 basis points of rate cuts. I don't recall ever in our lifetime where the Fed hasn't even started or has just started hiking, and the markets are pricing in 100 basis points of cuts in the out years. And I actually think that's a pretty likely scenario.
Brilliant. And I call it the parlor game. It's just, to me, it's just absolutely idiotic. But what you just said, what I find fascinating, and this goes to what Bill Dudley was talking about an hour ago, is the idea of in a year and a half. What does your world, seriously, what does the PGIM, insurance, asset management, conservative money world do if you get that magnitude of change over 18 months?
Yeah, well, I mean, that's probably our base case, Tom, that you're going to have growth slowing. I believe we're already at the beginning stages of what could be a pretty significant level of demand destruction from higher inflation, and now you're seeing higher rates and tighter financial conditions. I mean, mortgage refinancings are plummeting. Mortgage rates are pressing against 5% this morning. I mean, housing has become basically unaffordable for most of the people in this country. That is tighter financial conditions. Growth is going to slow. It's just a matter of how much and how fast, but certainly in a year and a half from now, we could be in a very different world where the Fed is pausing on rate hikes and maybe even contemplating cuts. So what you do as an investor, you try to take the long-term view, knowing that in 3 and 5 years, Tom, the funds rate is going to be back to zero, right? The 10-year will probably be back to 1 at some point over the next 5 years. So you want to take advantage of that, capitalize on that capital gain you can get by being long duration.
Tom, I just want to be clear. Did you just call the parlor game of trying to game out Fed policy into the future idiotic. Is that right,
No,
Tom?
I agree with Michael Collins. We're at an absolutely original place. I was talking to, I think it was Aquinas this morning about Richard Timberlake of Georgia. Timberlake never wrote about this. Meltzer never wrote about this. Anna Schwartz never wrote about this.
This is unheard of territory. And what we're moving toward, and Michael, this is what you were picking up on, the idea that at some point the Fed is going to trigger a downturn. You're going to see growth materially slow down. The question is, will it be something controlled or will it be a dramatic downturn, something that's a recession that's sooner than expected? Deutsche Bank came out and said that they expect a recession in the United States in 2023. Do you agree? Do you think that that's looking increasingly likely as we look at what the Fed has to do to get markets basically to believe them?
Yeah, I think the probability of a pretty significant global slowdown, and you're already seeing it, in big parts of the world, in Europe and China. We got PMIs out of China below 50 today, and the U.S. just cannot, be an island of prosperity unto itself. So you will see global growth slow. The question is, what does the recession look like? And I actually am pretty constructive on this one, right? And if you look at consumer balance sheets, you look at corporate balance sheets and the liquidity they have and the profit margins and the wherewithal to kind of withstand some weakness here, this is not going to be a big business or consumer-led contraction. I feel like it's going to be almost like 2000, 2001, where you get a big correction in asset prices possibly, and some pain in the markets. But back then you hardly saw consumer spending, go down at all. And maybe it's that kind of mild recession or big global slowdown.
Mike, you are just awesome. I've missed sitting around a table with you, sir. Mike Collins there at PGIM. Mike, thank you. Lisa, I think it's an interesting exercise. I had the conversation with Greg Peters at PGIM in the last 24 hours as well. If I could guarantee you that recession at the end of 2023, what would you do differently today? What would you do differently today in this market?
And a lot of people say nothing. They continue going into risk because they still have 6 months before they have to start going into cash. They don't want to miss that. It's the nature of the recession. People aren't going to be talking about just recession. It's how quickly it's a downturn. It's in what particular sectors. Is it led by the consumer or is it led by simply a lack of investment on the corporate side? We don't know.
You missed one thing that Tom said. He referred to our Australian producer as Qantas.
Yeah.
Is that what you call our team member?
No, it's his name.
Qantas.
No, it's his
Pretty
name.
Sure that's not his name.
No, it's his family nickname.
Is that right?
Yeah, I know it for
He's
sure.
named after
John,
an Australian
excess.
airline.
Let's put it in perspective. We need some history here before we go into this. I thought Senator Cassidy was brilliant. Excess profit taxes 31 years ago, 1991. At that time, the Dow was at 3,000. You know what? Life went on. We somehow got through it.
Let's keep it on energy. Viktor Orban of Hungary, the Prime Minister. Here's a couple of lines for you.
In winter.
He said he spoke to Vladimir Putin of Russia, urged him to declare a ceasefire, and then went on to say this, and this sets Hungary apart from Germany, from Italy, from the rest of Europe as far as I can tell. Hungary has no problem paying in rubles for Russian gas. That from the Hungarian Prime Minister, Tom, just moments ago.
Well, it's rubles from Hungary, but then they'll convert to what? And again, it's the ruble price and also the mechanism of that trade. The dollar is outstraded. Now, the bond this morning, John, was a foreign issuance of Russia, outside of Russia, and was dollar denominated from day one. But on a commodity product, I guess you do rubles and you keep some and you convert the others. There's a cost.
There's a political question here too, TK.
Sure.
Which you well know.
Yeah.
We'll catch up with Damien Sassower in the next hour. Looking forward to that. Also catching up with Jack Caffrey of JP Morgan Asset Management. And I'll be smoothing things out with the team. His name is Brad. His name is Brad. It's Brad, Tom.
Brad Qantas.
It's just Brad. It's just
I did
Brad.
not know that.
All right. Futures. Down 1% on the S&P. Honestly. Family therapy after the show. Looking forward to it.
Yeah,
this is Bloomberg.
We're vulnerable.
Keeping you up to date with news from around the world with the first word, I'm Rishika Gupta. An ex-oligarch says that from Vladimir Putin's perspective, Russia is already at war with the US and its Western allies. Mikhail Khodorkovsky was once Russia's richest person. The exiled oil mogul told Bloomberg that because of sanctions and arms shipments to Ukraine, Putin views Russia as fighting the West on Ukrainian soil. A nationalist Russian politician whose party was a key part of Vladimir Putin's system of managed democracy has died. Vladimir Zhirinovsky was 75. He was the founder of the Liberal Democratic Party. He was known for his outlandish and sometimes racist tirades. Zhirinovsky's party was part of the system that gave Russians the illusion of choice, but it invariably backed Putin on important matters. The European Union's foreign policy chief called a summit with China's President Xi Jinping a deaf dialogue. Joseph Borrell said China didn't want to discuss the war in Ukraine. That casts doubt on how much cooperation Beijing will offer to end the fighting. And executives at JetBlue believe they can win antitrust approval for their proposed $3.6 billion takeover of U.S. budget carrier Spirit. They also say they would pay Spirit a breakup fee if regulators block the deal. Spirit says it will evaluate the offer. 2 months ago, Frontier reached an agreement to buy Spirit for $2.9 billion. And Boeing is hiring the 3 biggest U.S. cloud computing companies to help with a digital makeover. The goal is to give its airplane designers and software developers more tools. Boeing has multi-year agreements with Amazon, Microsoft, and Google. The company plans to shift hundreds of applications to the cloud. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
The Indian city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its 2 biggest billionaires.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
I'm here at the Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. That Boeing is going to compensate SpiceJet in form of cash and aircraft. There's a big celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet chairman Ajay Singh. there are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
The Fed's going to have to tighten financial conditions enough to push up the unemployment rate. And when the Fed has done that in the past, it's always resulted in a recession. That's not their intention. They'll go for a soft landing, but their chances of pulling off are very, very low.
Bill Dudley, a piercing essay for Bloomberg Opinion this morning, linking the stock market and its level down the road with what the Fed will or will not do. Required read. We'll get that out on Twitter for you as well. And of course, his comments were really quite something as well. I want to make note here. Lisa, help me here with the ruble round trip, 80 out to 130 and back to 80. And it's now gone round trip off of the entering of the war in Ukraine.
Basically, it never happened to the ruble. And then what kind of market is this? Can we actually call this any kind of market that's reflective of where rubles would trade? Should there not be controls and there be more international interest?
It is the litmus paper of the system for what it is. I don't have a strong opinion on it other than to say I'm watching Russian bonds, which have had an ugly morning with questions about how they will be paid in dollars or ruble, and to see one bond of 2042 in Russia move on a dollar base down from 28 down to 27, 26, and even a little bit below that as well. Right now, we migrate forward on the equity markets. Kriti Gupta with an image. What do you have, Kriti?
Yeah, Tom, you're talking about a round trip for the ruble. You're also seeing a little bit of a round trip when it comes to the VIX. During the span of the war, you are seeing some of that kind of risk appetite that was pulling out, perhaps pull back in a little bit. Let's get to my chart of the day, which really shows the VIX going back about 5 years. And it shows you the average line. The average handle on the VIX between 2018 and 2019, essentially pre-pandemic, was about 15. Post-pandemic, it's gone to 25. Go to the war, it's gone to as much as 26, 27. Now you are seeing the VIX hover around a 23. What this really means is that perhaps there's a little bit of resistancy or perhaps pricing in the impact of the war in Ukraine. The other piece of the equation is simply when it comes to the equity market, who are the players right now? Tom and Lisa, my sources right now telling me that the institutional bid just isn't there. This is really a function of the retail trade.
There we are. And of course, the VIX on 23.22 after an 18 handle, and the good news of late last week as well. Kriti Gupta, thank you so much. A well-timed meeting with Lindsay Pieggs, the chief economist of Stifel. We're thrilled that she could join us this morning. Lindsay, I got to get to May 4th, and I guess there's the Ides of March, but tell me about the Ides of April. First, I got to get to April 15th. What data matters for Lau Brainerd, Jerome Powell, and Lindsay Pieggs as we try to get to the Ides of April?
I think first and foremost, the Fed is going to be focused on inflation. Inflation is the driver of the Fed's new, more hawkish position, and it's inflation that's driving this forward pathway for rate hikes. The Fed telling us now that the consensus is for 6 additional increases, potentially coming in 50 basis point increases. That new position, that more aggressive pathway, is driven by inflation. So as prices continue to rise, be that lingering pressures from the supply chain disruptions or new upward pressures from the Russia-Ukraine conflict, that is what is going to determine the pathway forward for the federal funds rate.
In goods and services, what is the distinction in moving from 7 to a surveyed 8.3%? Is that a goods oomph or a service oomph?
Oh, I think it's both. I think we're seeing price pressures in both. I think the Fed is washing the fact that prices are no longer transitory. They're now broad-based across nearly every sector of the economy. And that is sparking fears that we're moving closer and closer to a wage price spiral, where prices rise, pushing wages higher, pushing prices higher, et cetera, et cetera. And so the Fed is very much focused on capping inflation, starting to imply that second derivative decline, meaning a still positive pace of price pressures, but a slower pace, and then eventually moving on to an outright decline in price
right now.
Oh, I think people are overestimating the strength of the consumer. We hear about the consumer being strong. We hear about the economy being strong and the potential for the Fed to undermine this strength in the economy. The economy is not overheating. The economy is not strong. The economy is just moderate at best and arguably poised to already slow, as we're still struggling to grow organic legs in the aftermath of the worst of the COVID pandemic. Consumers are still very much relying on an accumulated savings as a result of very generous federal programs, as a result of a shift in spending patterns from pre-pandemic to post-pandemic, as we saw an additional check in many people's mailboxes for that enhanced child tax credit.
Yeah.
There were a number of different factors that really built up that wealth cushion, and that continues to support consumers for now, but it will not support consumers indefinitely.
Well, and that was really where I was going to go, the time frame here. How long is it going to take before that weakness that you're talking about starts to present itself in earnings, in other economic data?
Oh, I think we're already seeing the weakness. Even if you look at fourth quarter GDP, which was up near 7%, when you strip out inventories and we look at real final sales, you're talking about 1.5%. And Q1 GDP shaping up to be a significant disappointment, well below 2%. So we're already seeing that weakness. Now, I think the bigger question is, when do we see that translate into negative GDP? And I do think we'll continue to float around positive territory for the next 6 to 9 months, but getting that first outright negative print by the first quarter of next year.
You're looking for a negative print on real GDP by the first quarter of 2023.
That's correct. I do think at that point, the Fed will have raised rates enough to choke off domestic growth. Now, will we see a technical recession? That's a question for whether or not the Fed can identify the weakness and then pull back after a series of rate increases. If they continue to move forward, I do think we go into technical recession. If they have the wherewithal to pull back, we may be able to navigate not necessarily a soft landing, but a very brief dip into negative territory.
And there you are 2 days in a row, folks, as Lindsay Piegza pulls forward what Deutsche Bank and Matt Lazzetti were talking about yesterday from late 2023. If the Fed bollocks it up, maybe we see it Q1 of 2023. Dr. Piegza, thank you so much for joining us from Stifel. I was sort of shocked there, Lisa, by the word transitory. I waxed poetic. Oh, transitory, my transitory.
Oh boy.
We are so done. I mean, come on. I mean, remember when transitory was everything?
Yeah.
It was ages ago.
Well, and frankly, we've dropped the transitory word, and we've also now started to drop the concept, because for a long time after dropping the word, people kind of still clung to the concept that we'd see these base effects kick in. And base effects have become new inflationary pressures in the form of what we're seeing over from Ukraine and some of the disruptions in some of the exports from Russian oil and gas and the expectations there. At what point do we get to a place where we're crisis-free? I mean, can we just be crisis-free?
The only base effect that matters is from electroharmonics. They have a compressor to die for. It's got optofield to it.
Are you trying to sell me a base?
Into it.
Okay.
No, it's base effects. And I mean, electroharmonics of Long Island, they just kill at this. I'm sorry, they own it.
I'm looking at bond yields right now. I do think that it's important to reset, because if you take a look at what's going on in the 10-year yield, it's 2.62%. I love your guitar stories. I just can't really add much to, potentially build this out. But I will say, I think that the move in bond yields has been absolutely dramatic. Tom, do you think it's going to get worse or better after the meeting minutes that you're not going to read at 2 p.m.?
I think the minutes of the meeting will have bond market effects in us. Some of us and several of us will drive forward the story here. Stay with us on radio and television. This is Bloomberg. Back with you in minutes.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
From New York City this morning, good morning, good morning. Bonds down, yields up, equities lower. The S&P down by 0.9%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York City, we begin with the big issue, the global bond rout intensifying.
Big flight from the bond markets, how much the Treasury markets moved.
The 5 and the 10-year starting to respond.
A sloppy patchwork of random expectations.
This is the markets readjusting to a much faster pace. Having Lael Brainerd reiterate the fact they want to move very quickly.
They're trying so hard to get this soft landing and retain inflation credibility.
They need to get financial conditions tighter.
Every single inversion has been followed by recession.
Removal properly of QE, moving into that QT phase. The balance sheet is going to be an important tool to do that.
If the balance sheet does a lot of the tightening, the Fed may not have to raise rates significantly above neutral.
We are in kind of slightly uncharted waters.
The other big question is, does inflation actually decelerate?
This is an extra problem that investors are having to grapple with.
That is causing a lot of volatility, and the volatility in the bond markets means other people still can't hold bond markets, so the whole thing has been thrown up in the air.
Yields high this morning, up 8 basis points on a 10-year to 163, 263. I've got to get used to that as well. Flowbank's Esty Dweck joins us, Nuveen's Tony Rodriguez and Jack Caffrey of JP Morgan. Esty, let's just start here. Why are we finally waking up to QT when Chairman Powell talked about this on March 16th?
You know, I think there hasn't been such a big change in the content of the words, right? I mean, it's re-emphasizing what we already knew, but I think there was slowly, given the market performance, given the war in Ukraine, maybe a little hope that at some point in May we'd get a dovish surprise, if not on rates, at least on balance sheet. And now it's that second lever that's being pulled on the balance sheet reduction that might be still rapid, that's leading to further uncertainty because we don't know the conditions yet. And I think that's what's scaring markets at the moment.
Well, Governor Brainerd shaked things up just yesterday. Take a listen to what she had to say.
given that the recovery has been considerably stronger and faster than in the previous cycle, I expect the balance sheet to shrink considerably more rapidly than in the previous recovery, with significantly larger caps and a much shorter period to phase in the maximum caps compared with 2017 to 19.
Tony, this is what the chairman said on March 16th. It'll be faster than the last time, and of course, it's much sooner in a cycle than last time too. He said, look to the minutes. The minutes are out today. What are you looking for?
Well, good morning, Jonathan. Good to be with you. So we're definitely looking for some more color on what the QT is going to look like. Are they going to talk about caps? Are they going to talk about a start date? Clearly, over the last month or two, everything has accelerated pretty rapidly, both in terms of the expectations for when QT will start, where many people thought it was going to be a fourth quarter event. Now we're looking for that to actually kick in, probably at the May meeting, certainly by June, and where people were looking for 25 basis point hikes at the most over the next 7 meetings. Now we're talking about 250 basis points hikes coming up. So there's been a significant acceleration in the Fed's pace of trying to get to neutral. They're so far from neutral now that the market is welcoming these 50 basis point hikes. It's already priced in. So I think it's important for the Fed to take advantage of that and not disappoint the market at this point with what would be a dovish surprise that would probably backfire.
Jack Caffrey, earlier this week, Credit Suisse said that we were underestimating the power of QT. Do you agree?
You know, ultimately, we've lived for 2 decades around really liquidity-driven markets. And so this is clearly a move to a more negative surprise, if you will, that the Fed is going to be actually somewhat more aggressive rather than more passive. And so I do think QT is something that we really haven't had to think about in a very real sense. And it's going to ripple through initially through the fixed income markets into credit and certainly work its way into the equity markets as well. So we live in a very new world relative to what we've gotten used to, certainly in the last decade.
Heard from a ton of Fed speakers over the last few weeks, and seemingly they're all on the same page. Take a listen to Kansas City Fed President Esther George.
When you look today at where the balance sheet is and the conditions in which we'll be doing that, I think it easily argues for going faster and moving along at a quicker pace than we did before. We have a ways to go to get this accommodation out of the economy.
Mike McKee, they're ready to go.
They are ready to go. And if you take a look at the balance sheet, if the Fed were Christie's or Sotheby's, this would be their catalog. They have mortgage-backed securities, they have treasury bills, and they have treasury notes and bonds. And the question is, how much of each do they sell? And when do they start selling it? That's the color people are looking for this afternoon from the Fed minutes. We expect that the system will be the same. They will let bonds mature and roll off, and they will reinvest payments above certain caps. Now, the caps the last time were $50 billion in 2017. The general consensus seems to be about $100 billion. And when you put everything together, they've got about $5 trillion worth of additional stuff on the balance sheet now, so maybe they get rid of about half of it. Could take 3 years to bring it down to an effective level, but that's another thing we're trying to figure out. Also, the possibility that they may just let the treasury bills, since they're short maturities, run off no caps, and that would bring us down faster in the short run at the short end. Now, I want to show you what happened last time, and this is one of the busier charts I've ever done, so let me just walk you through it. Eric, you can follow me left to right here. The white line, solid white line, is the Fed's balance sheet in 2017. The dotted line is what the Fed was raising rates, the pace they were raising rates. And the yellow and blue lines are the 2-year and 10-year, and you can see they announced what they were going to do and set the caps in June, but did not start the balance sheet reduction until October. And then it went fairly rapidly. But then look what happened to rates. They rose a little bit as the market went down, and then they rolled over and went back lower. What's going to happen this time? We'll have to see. That circle there is where we had that taper tantrum at the end of the shrinking, and they had to reverse course on rates. So as you can see, it's a little bit complicated. They can move it faster, but the Fed doesn't really know what the impact is going to be on rates.
Mike, we need another 10 minutes to go over that chart. So Mike McKee, thank you very much. We'll try and put that chart back up.
TV Go, you can get the charts,
process
and take a look at it.
Digest it in your own time as well. Mike McKee, thank you. And Tony, as you think about that, and to Mike McKee's point, let's make this really simple. Do you think QT is Treasuries negative or Treasuries positive? Does it send yields lower or yields higher?
So I think in the early stages of it, you're going to see it send yields higher. So the lack of now the Fed being a purchaser in the market clearly has a negative from a liquidity and demand standpoint. And we still are dealing with inflation levels that are way too high and a Fed that is still well behind the curve. So I think in the initial stages, you'll see yields higher. As you get further along in the pace of QT, then you could see yields start to fall, because that's when you start to be closer to that recession risk that, you know, some folks are starting to forecast now for the fourth quarter of 23, early 24. Clearly the risk is high that there's a policy mistake. You know, it's a don't fight the Fed. Soft landings are difficult to accomplish. That's what leads to that rally in yields as we get further along in this QT process.
Esty, how does this conversation influence where you want to be and where you don't want to be in the equity market?
Well, I think it really depends on how high a probability you assign to this soft landing possibility. We know it's very difficult. We know the Fed is trying to re-anchor those inflation expectations and try to front load a little bit. But you have to believe that at some point later in the year, they're going to have the growth conversation and not just the inflation conversation. So you want to be a little careful of where you're positioned. We've seen that quality has done quite well, or quality defensives have done quite well recently. I think you are going to see Treasury yields move now ahead of the announcement. We'll see what the minutes give tonight, but preempting those markets a little bit, or the Fed meeting, of course, is to be expected throughout the rest of April. So we still think that technology at some point is going to offer some good opportunities, maybe not quite yet. But once you start to have those growth conversations, people are going to want to have that sustainable earnings growth factor that you get from a lot of the tech sector, and you should see a rebound there. In the meantime, still a little bit of room for some of the cyclicals, but that could just be a shorter term view depending on what happens in May.
We are already having that growth conversation. Deutsche Bank, the first out the gate, calling for a recession in the United States, looking for that at the end of 2023, also looking for a real deceleration in European growth as well. The moves they're expecting from the Fed and the ECB are huge. We now expect the Fed funds rate to peak above 3.5% next summer. The ECB raising rates 250 basis points between September and December next year. I have no idea if that's achievable. Just want to come to you quickly, Jack Caffrey, on all of this and just ask you a simple question. How defensive have you become in equities?
You know, I've always tried to balance and focus on quality. And so within that regard, I'm always somewhat relatively defensive. And that, I think, is what allows an investor to focus on compounding over time. And effectively also thinking about balance sheets and taking a bit less balance sheet risk, certainly going forward, because inverted curves also tend to come with little credit hiccups, and you don't want to be completely reliant on an ability to always roll substantial amounts of debt. And we do live in a corporate sector and a government sector with substantial debt. So at the margin, you become a little bit more focused on quality, which definitionally is a little bit more defensive.
We'll keep building on this. Jack Caffrey, Tony Rodriguez, Esty Twegg. Let's get you some movers. 20 minutes away from the opening bell with equities a whole lot softer. Here's Abby.
A whole lot softer indeed, John. The two-day sell-off, or it's turning into a two-day sell-off on those hawkish comments from Lael Brainerd. Right now, the NASDAQ 100 underperforming, down 1.5% in the pre-market, heading to a second down day of 3.7%, the worst in 3 weeks. Not surprisingly, big tech is much, much weaker. NVIDIA, CHEP's really leading the decline yesterday, down 4% in the pre-market, but it extends to the other well-known mega cap names such as Amazon, Apple, Microsoft, Amazon right now down more than 1%. What's higher, however, we do have encouragingly oil back up, because yesterday, of course, in the afternoon, oil tailed lower with stocks, those two risk assets trailing each other. But today we have oil up 1%, and that is helping out the energy complex, especially Occidental Petroleum up 1.6%, John.
Some interesting hearings a little bit later this morning. Looking forward to that, Abby. Thank you. Coming up, Russia facing a new round of sanctions.
In coordination with the G7 and the EU, an additional sweeping package of sanctions measures that will impose costs on Russia, send it further down the road of economic, financial, and technological isolation.
And the FX market asking a lot of questions. That's next.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
In coordination with the G7 and the EU, an additional sweeping package of sanctions measures that will impose costs on Russia, send it further down the road of economic, financial, and technological isolation. This will include a ban on all new investment in Russia, and increased sanctions on financial institutions and state-owned enterprises in Russia, and sanctions on Russian government officials and their family members.
Western allies coordinating another round of Russian sanctions. EU Commission President weighing in.
At this critical point in the war, we must increase the pressure on Putin again and the Russian government. And this is why we propose to tighten our sanctions even further. The fifth package has 6 pillars. First, we impose an import ban on coal from Russia, worth 4 billion euros a year.
4 billion euros a year. Your team coverage starts right now with Anne-Marie in DC, Maria Tadeo in Brussels. Maria, 4 billion. Doesn't get it done, does it?
Well, Jonathan, it does seem like it is small, but there's two things about this. First of all, if you look at the overall package that is going to get approved, I believe, in a couple of hours, but this is almost a done deal. Is guaranteed that it will get through. What the European Union says is that they look overall at 10 billion euros in Russian exports going into the European Union. Of course, 4 billion euros would be coal. Buyers will be told you have 3 months to wind down your contract, and then, of course, you're not able to sign on new ones, and then there will be also an export ban of European components going into Russia. But yes, you're very right. In the context of things, when you look at the amount of imports that we have going into the European Union from Russian oil and gas, this is just a fraction. It really is a drop in the ocean. Also considering in many ways the images that we saw out of Bucha, and the idea here, of course, is that sadly this is not the end of it. We're probably going to see a lot more Buchas across Ukraine. But what is key to me now is that the European Union has finally gone into the energy sector. Remember, for weeks we heard that they would not go there, and now they are. They're also saying now openly, perhaps as a means to pile on the pressure on Germans, that we are going to have a debate on oil. That is the next frontier, and potentially even gas. Now, it's not guaranteed that this is going to happen overnight, but to me, I would say, though, it is telling, and I would stress that this debate is now happening. And today, to hear from the head of the Commission, we are going to talk about ditching Russian oil. That is relevant, and that is important.
Is the move in the FX market relevant? Let's talk about that. Bring up the chart over 1 year. You'll see the spike in dollar ruble, weaker ruble. Then you'll see it roll over again, all in the space of about a month or so. The headline that crossed the Bloomberg a little bit earlier this morning, about 30 minutes ago, the ruble back to the level seen before the war in Ukraine. Now, Secretary Blinken, Anne-Marie, was asked about this over the weekend on NBC's Meet the Press, and this is what he said. People are being prevented from unloading rubles. That's artificially propping up the value. That's not sustainable. So I think you're going to see the change. Right now, of course, Anne-Marie, we're not seeing that change at all.
No, and Blinken and a number of other officials are saying that basically this is a fake market, and what you're seeing out of Russia is very, very tight capital controls, Jonathan, and the central bank doing what they can to try to prop up the ruble and maintain a ruble. Also the fact that President Putin is saying that if you want to continue to have imports of Russian gas, keep the lights on, keep the homes heated, then at some point you're going to have to pay for rubles. Now, potentially, we might see that happen in countries like Hungary. Viktor Orban was just on the tape saying to what Maria was saying, Charles Michel saying we're going to discuss oil and gas sanctions. He said absolutely not. He would never go for that in the European Union, and he's more than happy to pay President Putin in rubles for their natural gas. So the United States views what's going on in the ruble just completely fake, and that it's being designed within the Kremlin to get the ruble back up, to prop it back up.
Maria, you've just got back from Budapest. Viktor Orban, to Anne-Marie's point, does this make it increasingly difficult to do anything at the European level? That if you want to go that next step, that you'll have to do that as a nation, as a country, at the individual nation level?
It is, and Viktor Orban, I was there for 4 days, and I was reporting on the ground, and the one thing that really struck me is that Viktor Orban is unapologetic about this. You saw that celebration speech on Sunday where he said, this is our victory. It has given us a mandate. The people of Hungary do not want to get involved in Ukraine. He also lashed at President Zelensky, saying this is not our war. And today he's saying on the record, if the Russians say we have to pay in rubles, we don't really see that as breach of contract. But Jonathan, I had a conversation off the record behind the scenes with a very senior Viktor Orban official who told me that same thing 3 days ago. So now we see that what they say behind camera and now on the record and on camera actually does match the threats. So this is something that I believe will go in crescendo and makes decision-making very difficult because, as you know, in the European Union, if you want to get anything done, you need the 27 countries to agree unanimously. The one thing I would say, however, to cautious everyone here, Viktor Orban is someone who likes to talk tough, but every single package, including this one approved today and is the 5th package, he's actually voted in favor. So when it comes to him, you sometimes have to separate the bravado that comes with him to what he actually votes come crunch time. And by the way, he depends on a lot of funding that comes from this place, Brussels, going into his country.
The two of you have been absolutely superb, so thank you to you both. And Anne-Marie, we need to talk later about that House hearing with oil execs a little bit later too. Thank you to you both. Back with us, Esty Dweck, Tony Rodriguez, Jack Caffrey. Esty, what a difficult time to be long European equities. Italian bonds, the periphery selling off, the prospect of tightening coming from the ECB, higher energy prices, weaker growth. What do you do with the European stock story now?
That's really the question. Some of it will depend on your investment horizon. If you are thinking longer term, then the list of what you mentioned, you can add in the French elections with the first round now and the polls tightening a lot. Obviously, the growth question that is, I think, only going to increase over time. But you can wonder how much of this bad news is already priced in. You can wonder if some of these sectors that are a little bit more defensive, that have more quality and sustainable earnings growth, whether they're going to weather it. In general, we think that any of these companies or sectors that have more pricing power should be able to hold up better. Again, that's assuming growth holds up. But I think at this point, it's really a question of how much bad news is priced in, how much more or how much worse can it get, and seeing from the sanctions, potentially it can get worse, although we do hear that some fiscal help might be on its way in terms of energy and food prices and helping consumers with that. But at the moment, I think you have to stay cautious on European equities and probably have a still choppy and pretty ugly second quarter ahead of us.
Jack, do you still consider the US as the best of the rest?
Yes, the U.S. remains the best of the best out there. Effectively, it is the market which has a large enough domestic environment. It is certainly rich in most of what other commodities that people are worried about securing, whether it be food or energy. And it certainly has a group of companies which remain innovative and focused on growth, responsible growth, I would say, and actually is throwing off a bit more cash to its investors. So I think there's a lot to recommend the U.S. in a very uncertain world.
Tony, just finally, when do I start to get worried about the European bond market? When do I need to get worried about the Italian bond market?
Well, I think the time to get worried is if you actually start to see some of the risks to growth recede, and that would give the ECB more room to tighten. The growth picture might look better. But where we sit today with growth risks really globally from U.S. to Europe to China, and Europe so closely exposed to the Russia-Ukraine crisis and the impacts from energy being more significant in the European economy, I think that we're a ways off from having to worry about a real aggressive ECB, because the growth picture right now is, I think, fragile given all of the risks that they're facing.
Tony Rodriguez, Jack Caffrey, SD2EC. Your bond market in Italy, your 10-year up 10 basis points to 236. The energy story, we'll pick up on that in just a moment. Your morning calls up next and later. Oil executives heading to Capitol Hill. More on that. Coming up shortly from New York, this is Bloomberg.
Energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
Russian CDS showing a 99% chance of default within the year. We'll catch up with Damien Sassower of Bloomberg Intelligence on that in just a moment. Your equity market 5 minutes out from the opening ballots. Yesterday on repeat, we're down by 1%. Let's call it that. Down 0.9% on the S&P. On the Nasdaq, down by 1.5%. The move in the bond market, Treasuries lower. Yields up through the curve. On a 10-year right now, up 9 basis points to 263. On a 2-year, up by about 3 basis points to 254.49. A lot to talk about that in that bond market a little bit later with some Fed minutes coming out. That's the price action. Here are the morning calls. Bank of America downgrading Ava's budget to underperform, highlighting numerous headwinds, including ongoing supply disruptions and continuing COVID restrictions. We're down there by 5.8%. Next up, Raymond James downgrading JetBlue to market perform, seeing too many question marks following its takeover bid for Spirit Airlines. And finally, RBC raising its Valero price target up to 108, pointing to a constructive macro environment and improving demand. Coming up next on this program, Big Oil taking on the Hill. Listen to this for a title: Gouged at the gas station, Big Oil and America's pain at the pump. Going in front of the House Subcommittee for a hearing a little bit later this morning. Coverage of that up next.
report, and behind me you can see SpiceJet 737 MAX aircraft. Earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. There's a big celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
24 seconds away from the opening bow this morning. Good morning to you. Your equity market looks like this, down 0.9% on the S&P, adding to yesterday's losses, taking some more weight off the Nasdaq 100. Nasdaq 100 futures down by 1.5%. This off the back of what we're seeing in the bond market, developing going into Fed minutes. Switch on the board and get to Treasuries. Yields higher, much higher, on a 10-year by 9 basis points. This morning, a sneak peek of life above 265. Right now, 263.69. In the FX market, euro showing a bit of strength, up 0.2% on euro dollar to 109.29. And crude, 102, just about, up 0.2%, 102.15. That's the story in energy right now. Let's get you some movers. Here's Abby.
John, well, yesterday's sell-off is, of course, bleeding into today with stocks down sharply, especially the Nasdaq 100 down more than 1.5%, heading to its worst 2 days in 3 weeks. Not surprisingly, big tech really getting hammered, starting off with Microsoft, one of the biggest weights to the indexes, down 1.6% yesterday. Chips leading the slide. AMD today down 2.5%. We also have the likes of Applied Materials, the fab equipment maker, down 2%, and then Meta Platforms also down 2%. So fears of rising rates, this big move up for rates, pressuring valuation, causing investors to sell technology once again, John.
Abby, thank you. Energy stocks up by 0.75%. About a minute into this session, we're down 0.8% on the S&P. A little bit later this morning, 10:30 Eastern Time, a House subcommittee on oversight and investigations of the Committee on Energy, Commerce, the hearing as follows. Here's the title. Gouged at the gas station, big oil, and America's pain at the pump. This is what Senator Manchin said going into this, and my thanks to Anne-Marie for sending this over. This is the quote. I just pray to God they don't come here on private jets. Better to walk or hitchhike. That will be the first question that's asked. Anne-Marie in D.C. joins us now. Anne-Marie, just the title of this, gouged at the gas station, big oil and America's pain at the pump. Is this a conversation, or are these guys going to get roasted for hours this morning to clip the thing, to play it out going into the midterms?
Well, I think it depends who's asking the question. So if it's a Democratic lawmaker and the title really tells you what's going to be asked about, they're going to talk about the profits that big oil companies have made, the higher stock prices, the higher oil prices, and potentially what we are not seeing, which is a decrease of everyday consumers, what they're paying at the gasoline pump. But then, Jonathan, on the other side of the aisle, the Republicans are going to want to make this about the Biden administration and what the fossil fuel industry feels like is a quite hostile approach to them. But it's an interesting time that this is happening, because at the same time, you do have officials really wanting to engage with Houston and the Permian Basin and get drillers back to work,
because what they are seeing in the global oil market, which is higher prices due to the fact that many are shunning Russian oil.
About a month away from getting earnings as well from some of these names. AMH is going to be must-watch TV a little bit later. Thank you, as always. Katie Lyons, these stocks have had a monster run year to date.
Yeah, far and away the best performer in the S&P 500 on a sector level, John. And a lot of these companies have seen their stock prices do quite well. Just to run through the executives that will be at that hearing today, you have chief executives from Chevron, Exxon, Shell, BP America, Devon Energy, and also Pioneer Natural Resources. And I actually spoke with the Pioneer CEO, Scott Sheffield, alongside Guy Johnson back in February. And he said, even if it's $150 oil, even if it's $200 oil, it will not change our production plans. And that had drawn the ire of President Biden last week in that speech where he announced the major tapping of the SPR. He said oil companies really need to stop prioritizing profit and returning capital to shareholders while the American people are watching. And obviously, John, the American people also are watching those pump prices tick higher and higher. The average price was up a full dollar in the first quarter. It's now around $4.16. To put that another way, it would take someone making the minimum wage 34 minutes of work to buy a single gallon of gas. That is the highest going back to 2008. So while it's pinching the pockets of consumers, especially on the lower end, it is not pinching the pockets of these energy companies. This is what you and Anne-Marie were just alluding to. Take a look at these numbers. Exxon expected to pull in $37 billion in net income in the current fiscal year. Shell and Chevron not far behind that. And Pioneer, who I was just talking about, a record $7.1 billion is expected. How do these companies navigate this earnings season when they have to talk about the money they are raking in, the money they are returning to their shareholders in an environment like this one, John?
Kaylee, you mentioned Pioneer. They actually put that in the press release last week.
Yeah.
And they said one CEO even acknowledged that even if the price goes to $200 a barrel, they're not going to step up production. Katie, thank you. As always, Katie Lyons there. Just breaking down some of these moves ahead of this hearing later. Esti Dweck, simple question for you. Do you still have an energy overweight?
We still have a slight energy overweight, yes. We had the overweight before, actually already at the end of last year in our portfolios. So before oil prices really moved this high, we thought that the move higher post-COVID hadn't yet been reflected in a lot of these companies. We've taken some profits and trimmed that to some extent, but we do think that there is still some upside potential just from a purely, I'd say, earnings and again, catching up perspective in terms of the energy sector.
Jack Caffrey, they're about to get roasted on Capitol Hill. Would you be comfortable with being long those names?
You know, I think the industry's behavior has changed dramatically, and I think that makes them a lot more interesting today going forward. But to be an energy executive going in front of the House of Representatives is typically to be a punching bag. I think it comes with the game, or it comes with the role. And so I do think, you know, when you look at the fact that they are returning capital, they are being disciplined with their budgets, and they are responding to a rapidly shifting regulatory environment. They're making the decisions you want them to make as an investor rather than a trader. And so I do think you need to actually be looking at getting a bit longer energy, even with the stock rally.
And Jack, would you view this in the same way we viewed some of the tech names? They go in front of Capitol Hill, they take a beating, but ultimately there's nothing they can do legislatively, and ultimately the earnings keep pouring in and those names keep performing. Is it the same thing or is this different?
It's a little bit different because you certainly have, you know, a lot of the energy complex has pressure politically. It has pressure from the rise of ESG. It has pressure from a whole host of from investors in terms of the amount of money invested that did not generate a return up until very recently. And so from that regard, you know, I look at energy, it reminds me a lot of, say, perhaps tobacco 25 years ago in terms of it being very unpopular, very much willing to change how it behaved and become very focused on recognizing that its future might not be as bright. And as a result, it becomes more of a cash return story.
Connection lost.
That, of course, means that you have to somehow link short terms to the long term. And I think the energy companies are going to point to, look, there's a lot of different regulation. I just can't flip a switch and suddenly produce an extra 1 million barrels. I need sand. I need truck drivers. I need steel. I need permits. I have to decide what happens with the natural gas emissions that will come out as I drill oil.
Yeah.
And so, you know, give me your clarity. Give me rules that make sense and that I think can last for more than 3 months, and then I can respond prudently. But until that happens, hard to respond.
and those stocks have been up big time, up 38% year to date. Picking on Pioneer, given their recent comments, it's going to be very interesting to hear what they've got to say today. That stock is up year to date by 35%. Tony, can you help me understand how you're thinking about this phrase demand destruction, which is a phrase that's been thrown around a lot at the moment, even more so given where energy's been trading?
Sure, Jonathan. And I think the key points on the energy sector are that they have become disciplined asset allocators. So the balance sheets are in strong shape. And that the commodity price environment, when you look out over the balance of this year and early into next year, is pretty healthy. So prices are going to remain high. The risks to supply are going to remain high. So we think that you're going to see a complex that stays certainly in the high double digits, maybe even north of 100. As you get further into late 23, and you talked about the Deutsche forecast for recession, we do see moderating growth. You do see that the cure for high prices is high prices, so there will be some demand destruction, both from a price perspective and from an overall growth decline. So we do think that the outlook as you move into later 23 certainly becomes more difficult for the energy complex.
The economic data in America still looks really decent, robust, resilient, call it what you will. Tremendous, some people might say, looking at the labour market data points. Esty, the equity market, though, is sniffing something out. The home builders in America are down year to date in a big way. The transports more recently, and never mind the yield curve inversion, let's just focus on stocks. Esty, is something starting to brew, something starting to build for you?
Well, there really is that big question of growth and of a policy mistake. You understand that it's a very tricky position for the Federal Reserve. They need to re-anchor those inflation expectations. They need to bring inflation down, although higher rates aren't really going to bring down energy and food costs right now. And any supply chain disruptions that are still driven by China's zero COVID policy aren't going to be addressed either by higher rates. So this is really about the longer term and those expectations and bringing those back in. But it's such a tricky balancing act to avoid a recession that if we have hawkish minutes tonight, if the May meeting does have these 50 basis points and balance sheet runoff, and it is quick, that question about whether the U.S. can avoid a recession is going to become louder and louder. And I think we're going to see in that second quarter more choppiness in the markets, more questions about what the outlook is going to turn into over the second half of the year, and of course, looking into 2023 already. So a difficult quarter ahead, but beyond that, as I said, I think the Fed is going to think about that growth question, is going to at some point pause and not push it too far in terms of the rate hikes. And that means that the second half should be much more comfortable for the equity market that, again, is already pricing in a lot of bad news and a lot of tightening.
Jen Caffrey, I wanted to give you the final word. In your notes, you said the one industry that provides the towel on the U.S. economy is housing. The home builders on the S&P down again today, and on the year to date, they are down by more than 31%. What's the towel there?
Well, look, the housing cycle is the economic cycle. It's a major employer. For most Americans, their home is actually their source of wealth. Tremendous employment. It works its way through, bank lending activity to get your mortgage. It goes through the building products businesses. It goes through the industrials. And we've had undersupply of housing for a decade. That said, though, mortgages a year ago were 2.5%. Today's data said a 30-year fixed rate mortgage is 4.9%. So there's a price shock in order to buy a house. And so a slowdown in activity, I think, makes perfect sense. But you're still dealing with an industry operating from shortage. But right now, investors are conditioned to think mortgage rates spike higher, housing activity slows, sell stocks. And they are not necessarily giving the home builders the credit they perhaps deserve from having dramatically improved their business. But, you have to survive the short term to make it to the long term. And right now, it seems like there's going to be more pressure than not on the home builders.
Would you buy this weakness?
I think there are possibly better ways to get exposure to the housing trade because, let's face it, something in the order of 85% of home sales and housing-related activity are existing homes rather than new homes. And so I do think that the consumer is more likely to have to stay where they are rather than purchase a brand new home over the next several years, given the backup in rates until we can get mortgage rates back down. And that's going to come back to where Etsy was talking about the Fed minutes. What does the unwind of the Fed balance sheet look like? Is if you start actually increasing mortgage spreads on top of the backup we've seen in rates, that buying that first house is going to be something that people are going to have to talk about in their future, not their present.
Jack Caffrey, Tony Rodriguez, Esti Dweck, thank you to all three of you around the opening bell. Equities are down about 10, 11, 12 minutes into the session by more than 1% on the S&P. The Nasdaq down by 1.9%. Brutal in Europe. The Stock 600 down 2%. Take a look at the Euro Stoxx 50. We're down there by 2.8%. Guy Johnson will pick things up in about 20 minutes' time. Coming up, Western allies ramping up the rhetoric against Russia.
There must be, and there will be, severe consequences for all those responsible.
And Russia skirting even closer to defaulting.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
It's almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada, tapi nggak kayak dulu. Kalau dulu rame sekali, sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 itu nyampe dapat jualan, bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu, sama aja. Belum ada turis ke Bali, masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
People are being prevented from unloading rubles. That's artificially propping up the value. That's not sustainable. So I think you're going to see that change.
That was Secretary Blinken to NBC over the weekend, reflecting on the fact that the ruble is getting stronger, not weaker. And the headline crossed the Bloomberg moments ago this morning, the Russian ruble rallying back to a level seen before the war in Ukraine. Dollar ruble right now, 83.37. Damien Sassower of Bloomberg Intelligence joins us. Damien, you and I have gone back and forth on this. Just how much of a market is there? Do you take the line that Secretary Blinken is pushing and has pushed over the weekend?
Absolutely, absolutely. Secretary Blinken is square on the peg in terms of saying that the dollar-ruble cross rate that we're seeing, which is, by the way, the local dollar-ruble cross rate, i.e. the rate that's being exchanged locally within Russia, is not reflective of conditions. If you want to know where conditions are, Jonathan, you have to look at Russian credit default swaps. And you want to talk about jump risk, let's go there. Yesterday, 5-year Russian CDS was implying a probability of default of 99%, right, within 5 years. That's doubled overnight based on the fact that Russia has agreed to pay the remaining balance on its dollar bonds in rubles. So that's basically the market all but implying a default. And what's happened here is that spread into the one-year probabilities. We're now priced at 99% probability of default in Russia within the next year. So the market is telling us a default is imminent.
Let's talk about the why they send rubles. So this was the story we put out this morning. The ministry said it had to send ruble payments to the National Settlement Depository after foreign banks rejected its payments for bonds maturing this Monday and a coupon for notes due in April 2042. Can you run me through this, Damien, why it has been rejected and why we're starting to talk even more about a word you used yesterday, the logistics of this, not about ability and willingness, but the logistics of getting money from point A to point B?
Well, we know why it's being rejected, Jonathan. The JP Morgan appealed to the U.S. Treasury to ask whether or not it could process the $649 million in payment, and they said no. So the U.S. Treasury is basically preventing JP Morgan from making those payments onto creditors. That's what's triggered the move in CDS. And obviously, here we are today, planning for a default, just taking a step back and looking at what comes next. What comes next? So basically, right now, actually 2 hours ago, the Credit Derivatives Determination Committee in London was meeting regarding Russian Rail's inability to pay a coupon on a Swiss bond back in mid-March. If the Determinations Committee does indeed determine this to be a default, monies will change hands. Once credit default swaps start changing hands, and in the case of the Russian sovereign, there are $41 billion of defaults outstanding. Once that all begins to change hands, the floodgates are open. And so for me and from my perspective, it's absolutely critical to keep an eye on that, see if anything comes out of that today. We know Alrosa, Oleg Deripaska, is applying for a special license to be able to pay his clients. He has been unable to do so. And also, just yesterday, Russia's second largest bank, VTB, has also tried to pay its dollar creditors in rubles because it's unable to do so in dollar or euro. So it's starting to metastasize and spread to the corporate sector.
Is this starting to spread beyond Russian assets? In the mix this morning, of course, we've got the equity market down, much lower, much lower. In the bond market, yields higher, much higher by 8 basis points on 10s to 263. Are you starting to see this bleed into EM in a way that it didn't do over the last month?
Yeah, definitely. So, what we have seen jump risk in places like Turkey, in places like Egypt, obviously a big importer of wheat from Ukraine and Russia. At one point, Egypt CDS had jumped as much as 1,000 basis points on a 5-year basis. I think it's back down to 550, which is kind of, it's normalized a bit. But certainly we're seeing sovereign CDS across the board starting to rise off the back of this move overnight. And that is a risk, right? Because what it is implying effectively is that many of these countries, many of these emerging markets don't have the funds to pay back their creditors over the medium term, and that things are going to get very, very painful for their economies. We already see local yield curves in places like Brazil and Chile inverted. Basically, the pace of rate tightening, the pace of rate hikes in many of these markets is choking growth. It's choking their economies, and I think that's a real risk going forward.
Damien, does it choke the Russian economy? And this is the key question, and let's finish there. You and I'll talk further through the week, no doubt. Is this a problem for the creditor or the debtor?
My back-of-the-napkin estimates are calling for 30% peak inflation in Russia on GDP contraction of something on the order of 15 to 20%, Jonathan. That is obviously going to be very, very painful for households and corporates operating in Russia. And certainly if they're closed off from the international capital markets, it's going to be that much more difficult. So, yeah, the Russian economy is feeling it. Although, with that being said, the banking sector seems to have kind of normalized a bit in recent weeks. They're not actively going to the repo market. So that's kind of a step in the right direction in terms of locals in Russia. But my goodness, that economy has its work cut out for them.
Damien, what a tough time. Damien Sassath, thank you, sir, from Bloomberg Intelligence. Just breaking it down. It's very difficult, complex, because this one's not about the ability to pay, the willingness to pay. It's about the logistics, getting the money from point A to point B. And as Damon has told us a million times, that's getting harder and certainly not easier. This equity market's tough. The Nasdaq is down by more than 2%. On the S&P, we're down by 1.2% on the S&P 500. This with yields higher. Breaking down the sector price action, here's Abby.
Tough indeed, John. When we break down the sector action, it's pretty grim at this point because there's only a few sectors higher, and those are the true defensive sectors with one exception. Utilities, consumer staples, and healthcare, all true defense. And these sectors usually trade higher when yields are lower because the dividends look better, but people are so scared today, or at least cautious, that they're piling into those defensive sectors. Energy also higher, up with oil now slightly higher. Actually, it's flipped a little bit lower, so energy is higher too. But on bottom, once again, technology down 2% or more. Consumer services, communication services, tech, and consumer discretionary, all those mega cap. And you know, John, this is the story of the year, but you were talking about those home builders down so much in the year, and thanks for bringing that to my attention. So you have those home builders down nearly 30% on the year. You have the stocks down about 20% on the year, and you have the NASDAQ 100 down about 10% on the year, each headed toward the worst year since 2008. I know that the year is young, but again, this is a brutal picture given that the home builders, as you have been bringing up, and chips, leading sectors, perhaps a tell on a tough year.
Mortgage costs are going one way, Abby. They're going up in a big way. Abby, thank you. Coming up, your trading diary from New York. We'll run you through it and why the Fed minutes later this afternoon seem to be the main event. From New York, this is Bloomberg.
What's happening on Wall Street?
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question. Great question. Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
"25 minutes in, this one might hurt a bit. We're down another 2% on the NASDAQ, down 1% on the S&P 500. The story like yesterday on repeat. Equities lower, treasuries lower, yields higher. This is the story, 2s, 10s and 30s. Your 2-year up another 2 basis points. That move fades a little bit, still up 8 on a 10-year at 262.19. That's the price action. Here's the trading diary coming up shortly. Secretary Yellen testifying before the House on Capitol Hill, followed by testimony from U.S. oil executives at 10:30 Eastern. The FOMC minutes coming at 2 p.m. this afternoon, plus another round of jobless claims tomorrow morning. Fed speak from Bullard, Bostic, and Evans. Look out for the Fed minutes. That's all that seems to matter. Chairman Powell told us 3 weeks ago we'd get detail on balance sheet reduction in 3 weeks. 3 weeks later, time's up. Your minutes come a little bit later. Yields higher by 7 basis points on a 10-year to 262. This was the countdown to the open for our audience worldwide. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi-Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in sari stores every day, also on TV, radio, newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113A, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complications due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi Number Fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's Number Fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning 1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack on the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venegold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why he may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Weinergold as an opportunity to leave that troubled home. Weinergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Weinergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Weinergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Weinergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and it will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environments, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then like, well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if they, if you go forwards in time, would fall on the surface. You calculate them backwards to today. And then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid until